Hey guys, how are you? Quick sound check. Can you hear me? Thumbs up if you can hear me, everybody. Great. Awesome. Can you see the screen properly? Thumbs up. Great. Awesome. All right, so let's see here. So this is for YouTube Live. Janice, let me know if you're there, and anybody else that's watching YouTube Live, let me know in the chat. Guys, if you have any questions, drop them now in the chat box, whether on YouTube Live or drop them in the group chat. Let me address something regarding yesterday. We're talking about qualifying ratios. I'm going to create a quick video tomorrow because the one I had, for some reason, I told you, those that stayed after. I merged the channel that I had Bruno Quintella with the one that's New Direction School, and I lost a few videos. I uploaded them. For some reason, some of them are corrupt, and guess what? The one that that you need from yesterday, qualifying ratios, that some of you asked, is one of them. So I'll create a new video tomorrow, or maybe even tonight. We'll see. We'll create a new video for the qualifying ratios. If you guys need other videos, please let me know. Send me questions. Send me as much as you can. Show me that you're studying, not just tell me that there's typos in my Quizlets. Okay, so show me that you are studying, and I will definitely create a quick video for you. Okay. Now, Daphne, I have to address this real quick. Are you there? Can you hear me, Daphne? Hi. This is not a build an exam foundation, so we won't have different exams. I'm just kidding. The way it works, so I'm going to address you and Gary, because Gary mentioned something too. But this is for everybody. The way it works is you start with this class, and a few years ago, I used to teach, and the school policy at the school that I was at was, hey, they'll take the exam whenever they want, whenever they're ready. The problem is, and some of you are here know that, the problem is that whenever they're ready, it never comes. And then the time expires, and then you don't do it. So I'm not forcing you to take the exam to pass, but I'm forcing you to take the exam either on the 6th or on the 7th. So you're following this class the week after you take the exam. And I'm forcing you to take it to see where you are. It's for you to understand where you are. It's for your own knowledge, okay? So I am not going to evaluate you based on the result you have that day. I'm going to evaluate your results and help you understand your results to pass the next time. If you pass on the first day, great. If you fail, just learn from it, because failure is actually not passing and then just giving up. That will be failure, okay? So the fact that you, if by any chance you don't have the score to pass that day, the fact that you'll take the results from that exam, turn it into something positive and try it again and pass, that's still success, okay? So you don't fail, you only fail if you don't do anything after. You got it? So make sure you guys give it a try. Pearl says, that sounds good, great. Steven says, so after we're done with the 75 hours, the following week, we take the test. Absolutely. So you complete the 4 weeks, and the week after, you take the school exam. You guys paid for 2 school exams, okay? It's included in the package. Now, the first one, like I said, could be the only one. But the first one is really just for you to assess yourself and see where you are. If you've been true to the studying portion after you're done with the class, you should be able to pass. But if you're having difficulty and you don't ask questions, then guess what? The exam will be difficult. So if you don't ask me questions, I'm not available only during the class time. I've replied a few of you that ask questions outside of class time. I stay even longer after class is over. So you just got to ask questions. That's the most important thing, okay? So I'm here for that support. I don't care about, you know what? It's good to make the money, right? I appreciate you guys paying, right? But I'm not here for the money. I'm here for a long-term relationship and be able to help you guys succeed and hopefully we'll do business in the future. That's my main goal, you see? So the money is not what's important here in this class. So 24/7, send me messages. I might not reply at certain times, but you can send me at any time. Okay? Yesterday I was up until 3 o'clock in the morning. I've replied to people at 2 o'clock in the morning. So let's do it. Okay? Just ask questions. Let's see. Speaking of which, let me go to the chat just to put on. Let me address again. If anybody's watching on YouTube, make sure you let me know you're watching, and let me know if you have any questions as well. So that being said, let's go here to this. It says, thanks, Gil. Appreciate it. Joe, how many times can we take the test? 1. You paid for 2, but you can only take it 1, okay? Don't worry about it. Just for now, just focus on studying and passing. Don't ask how many times you got, because then you're already setting yourself up for the next time and the next time. Okay? Cool, Janice. All right, so here's the thing. What you need to understand about the exam is just try to do your best, relax, enjoy the process, but try to do your best in that exam. Don't think of the outcome. Don't think, oh, I'm stressing halfway and I'm not going to pass. I'm not going to pass. No, don't do that. Enjoy the process. If you pass, great. If you fail, great. You got it? So don't focus on how many tests you got. Do that one, and then we'll see. We'll talk about it after. So Gil, Crystal is raving about your big thumbs. All right, next. Vanessa, can we participate in the next 75-hour course? Absolutely. In fact, I have Jonathan, for instance, here on the line, and he's participating. He's been participating. I guess he just he loves being in class, you know. Also, I have on YouTube, I have Janice. Janice keeps on watching the classes. I mean, I don't stop you from it. You have up to 1 year to complete, and then I'll kick you out. Let's see. Steven says, I just know most likely I will need a second, but I'm studying, just having trouble. Okay, again, ask questions, Steven. Just ask questions. That's all. Perla, so we can take your school test twice. Once. And then we'll talk about the next one. Crystal, yeah, today I'm on a roll. That's what it is. I'm sorry. I had a couple of people suffer with me today already. But I still answer the questions. Anyway, Chad, 1 year free rent, absolutely. Guys, I really don't care. As far as you guys understand one thing, the registration is valid for 1 year. Okay, that's the registration. That means you have to complete the course within 1 year. My goal is that you're done with the class and pass the exam and move forward, make money. My goal is not for you to be here for a whole year. You got it? If you want to, keep on coming back. I don't care. 1 year, 2 years, 10 years. You want to be licensed and still come back to class? I've had people do that. Hey, they just want to go back to the basics. So totally up to you. All right, next. Gil, when we pass, right here. When we pass, which we will all, comma, can we, scare period, can we schedule right away? As soon as I give you the certificate, I'm going to give you a link for you to enter your information. Okay, once you enter your information there, that's the information I'm going to upload to PSI exams. And as soon as you receive an email, so it should be the same day or next day, as soon as you receive an email, you will be able to schedule your exam. Queens and Allentown are still working. Some locations in New Jersey are canceling, not all of them. But yeah, most likely Fulton Street is the place to go in Queens, New York. Okay? So, Fulton Street, there you Perla, can we participate in the morning classes? You can participate in all the classes. I've had people do morning and evening class just to speed up the process. Okay, so you can just be in any class you want. Okay, you have full access. That's what you paid for. I know I should charge like 3 times the rate for the stand-up comedy, morning and evening, but you know, I'll give it a pass on that one. Jane, come on. This is more material than college? No. College, you take years and years. This is 75 hours. All right. Let me see here. Let's do roll call real quick. And then we're going to start. So I got Jane, Steven, Anthony, Perla. You're going. Oh, there you go. Okay. You were just messing with me. I see that. Vanessa, Crystal, Moses, Lena, Flavio, driving. Geraldine is gone. Natalie, Catherine, Gil, Mr. Big Thumb. That's your nickname now. Daphne, Joseph, Peter, I see you. Carlos in the car as well. I see a driver's seat. No driver. Mina, Youssef, Meredith, I see you. Luz, hope you feel better. Chad. Janessa. Brian, Yamili. Who else? Hold on. Heather is in the car. People, like, it's contagious. 1 goes in the car, 3 go in the car. Gary, Riley, Linda running around as usual. Sabrina's like not laid back. It's not all the way to the front, like halfway. I see you. Okay. Nicole, no screen, no image, no nothing. David, I see you, but then you disappear. So I know I see you for the next 2 seconds, and then I start and you're gone. Tidy, Sarah, Jonathan, Daphne, Sandra, and Pedro. All right. Cool. So let's see what we got. A couple more questions. Did you pass the first time? Who? Me? Hold on. Where's Riley? She asked me a question. Right there. Did you're asking me if I passed the first time? I'm not the one to be an example here because I did and top of the class, so I'm not going to be the example here. But there are certain exams that I did not pass the first time. This one I did because I was also, I think because I was also an investor at the time for several years. So I was already into the real estate. And also in my in 2005 when I started investing in real estate, 2004, 2005, I also took the real estate course. So I already had a little bit of it, okay? So when I came back to class years later, I was comfortable with the material. So not really an example to to the class. All right? Yeah, Gary. Okay, let's see. Hold on, I got a message here. All right. So let's go. Let's get this started. So if there's no questions regarding, yes, okay. Crystal says wait. Okay, I'm waiting. Making sure my phone is on silent. No problem, David. All right, so Jonathan, you quit? How about you announce first why you're quitting, Jonathan? That's why he knows there's exams on Fulton Street. He just passed today. Round of applause. So he's done. He just came here to brag about it and tell you guys to. You're gonna give some motivational speech real quick, Jonathan. Give us some answers. Chat, for a second, I thought off to your first date. That's what it looked like. I don't know why. That's what it looked like. And right after comes drinks on Jonathan, so. Keep trying to give up. Thanks, Jonathan. There you go. And he has, by the way, he has whatever he remembers. We've been going back and forth. So that's one of the things I ask everybody. I've been asking for years for my students, that whatever you can remember from state exam, let me know. Most of the stuff is very similar to what I have already. So I try to make my exam as close to the state as possible. Okay. Meredith, can we share some topics? Yeah, I'll tell you right now. It's 22 chapters. Those are the topics. Oh, I like this. Jonathan, no more lobster on me. Look. Crystal, I'll address it in a second. Sorry, it's just that everybody's writing here. All right. So, Jonathan, it's a date, first closing. Everybody's going to your house for barbecue. Done. Set. All right. So I appreciate you. Thank you for being coming here and also passing. That's amazing. Looking forward to seeing your success. And for those of you that are here from the previous class and you're hanging on to the last review because the exam's coming, it's possible, right? All right, so I'm going to move forward. Jonathan, I'll talk to you. If you stay here, great. If not, then I'll talk to you later. And let's see what Crystal was writing. Hold on. No. So for you to take the July 25th, you must have completed the 75 hours. For you to take the school exam, you can practice online. There's a practice exam online in the student portal. You can practice online. It's very similar, but the school exam is it's a one-time link for a one-time Zoom. It's only available for that day and for those that completed. And Pedro and I are monitoring the students that have completed. All right, so you qualify once you complete at least 90% of the course. Okay, so unfortunately, no, you have to wait a little bit longer. Also, as far as August 6th, the exam is going to be, right now it's available for August 6th and 7th. So the way I've been doing is the class, because it's so many people, we try to break it in, just as I said, Pedro and I have to monitor everybody. We're paying attention to every single detail. We get announcements of everything that you're doing. If you go to a different browser or something like that, we get notifications. So we need to pay attention. We need to proctor the exam. So I don't want to have too many people. We break it into two. So August 6th, August 7th. We're working on something that most likely then will be just one day. And then, so it's going to be either a Thursday and the Saturday, a couple of weeks later, or it's going to be a Friday and a Saturday, a couple of weeks later. But your first exam is always 1 week after you complete the 4 weeks, okay? Yeah, it's a Zoom setting because unfortunately it's the only way we can do now. But you go through my website for the exam, so I'll give you a link during the Zoom. It's not a link I give you before the Zoom. So I create a meeting just for the registered people for the exam. Once we get into the Zoom meeting, after I have everybody in, I give a link and a password for the exam. So it attaches to you, okay? So it has to be very controlled, unfortunately, especially at a distance. It's even worse. So very controlled setting. As far as the state exam, Heather, can we take it anywhere? Anywhere in Jersey, PSI Exams has different locations in New Jersey. And I think you can do, there's a place in Allentown, PA, and there's 2 places in New York. I think right now it's just Fulton Street that's working. But 2 places that you can do the New Jersey exam, okay? But once you get into PSI Exams website, you will be able to see the locations that are available to you, okay? Gil, yep, they're all multiple choice. State exams multiple choice. I make mine almost a replica of the state exam, so it's easier for you when you get there. Which fingerprint should you choose? They're gonna ask you for all of them. And there's no 3 choices. I hopefully you got 10. It's the salesperson one. So make sure you follow the video. Make sure you follow my video. There's a link there to a PDF, and that's the state PDF. It comes with it's actually in the Perla. Yeah, it's on YouTube, but it's also on the student portal. If you go to student resources or course resources, right at the bottom it says fingerprint, test yourself, schedule state exam. All that is at the bottom, and there's a link there for you to download a form that has all the information you need to enter into the scheduling site. Okay? So make sure you follow that video. All right? Jonathan got out of the Zoom, but he said on the WhatsApp, if you guys saw it, he says, good luck to everyone. All right? Vanessa, you meet or you met? You saw him today? You met him today, first time? All right. He's a cool guy. Home inspector. So if you guys need a home inspector, there you go. Sabito is the guy. At least he's the one that I recommend all the time. All right, so let's start the class. So you're in good hands, Vanessa. Okay? It's not State Farm, but or Allstate. Which one is the good hands? Neither one. All of them take your money. All right, so let's go here. Cool. Perla, yes. So sorry guys, this is actually a good question. Sorry to go back, but yes, yes, and yes. Doesn't matter how many times you got fingerprinted. I did 4 different licenses in 5 months. I had to do fingerprints for all of them. All right, so you have to. It's different departments, and from January till now, Perla, from January to now, let's say you committed 1 crime, 2 crimes, 10 crimes. We don't know. So yes, you have to be fingerprinted again. Okay. After you get into the business, you don't get fingerprinted again until you get your broker. So now you can commit all the crimes you want. Don't worry about it. But stay clean until you do your fingerprints. Okay. All right. Second part of financing 2, primary and secondary markets, right? So one thing you guys need to remember, if you're not going to ask questions, I'm going to address them. One thing you guys need to remember is primary market is where loans are originated, where everything starts, right? And then when we go to the secondary market, loans are bought and sold. Now there's a lot of influence from the government in mortgage lending. We know this. We know about FHA already. We know about VA, right? We know about the government grant program, which is the, for instance, the New Jersey Housing, Mortgage, and Finance Agency, the RECD as well. So these are government influencers when it comes to the mortgage market. We also have the Federal Reserve. Now, for those of you that don't know what a Federal Reserve is in terms of mortgage, they pretty much establish the credit conditions or criteria that will be favorable for the banks. Also, they control the interest rates and their reserve requirements. So they lend, or they might lend, so they don't always lend, but they lend to the banks at a certain percentage, and banks lend to you at a different percentage. All right? So right now it's ridiculously low, and it's been ridiculously low for years, but the banks are borrowing almost at 0 and charging you 3, 4, 5. So that's where it's been for years. So Federal Reserve, pretty much what you need to remember is if there's a question, is this. They control the reserve requirements and discount rates or interest rates for the bank, okay? As far as secondary markets, the primary market which the chapters dealt with thus far includes lenders who supply their own funds, so they lend, like mortgage bankers, they lend their money, they originate the loans, right? Right here, originate loans, supply funds, and so on. And then loans, as we said before, they are bought and sold in the secondary markets after they've been originated. So we've covered this yesterday. A lender, why would they sell loans in the secondary market? Why would I get a loan and sell it? Well, the idea is to raise immediate funds. So think about it this way. I lend to, so I'm going to go base what I have on my screen right now. I lend to Jane, right? Because it's Newark. It's a hot market. There's a lot of people buying. I got 38 people on the line. All of you want to buy, but I don't have money to lend to all. So what I'll do is I'll lend to Jane, and then I have money outstanding, right? It's not in my account. It's somewhere out there, right? So now I'm going to go to Chase Bank, and I say, hey, Chase Bank, Jane has a loan with me. She has to pay over 30 years, X amount of dollars plus interest of X amount of dollars. So this is the total. Would you like to buy this note? So it's the same thing as assigning a check. Like when you go to a cash checking place, that's what you're doing. You're assigning the check. In this case, they're assigning to a different bank. You guys talked about this on Friday. Assigning, right? And if Chase takes it, then Chase is giving me money back. What I lent plus a little bit more, which is my profit. But guess what? Now I can lend to Steven. And Steven is not the only one that wants a loan here in the area. We also have Anthony, we got Perla, we got Vanessa, and so on, right? I don't have money for all. So now I'm going to go to Wells Fargo. I'm going to go to all these different other banks that I work with, right? Or hedge funds that I work with, and so on. And I sell it to them. Again, to raise immediate funds to keep on lending where there's a demand for it. You guys got it? Why do they sell the loan? Because they need to raise money to keep on lending. And they take a small fee on top of whatever we lend. We take a small fee, and that's what keeps us rolling. So imagine this. Imagine, great question, Daphne. I'm actually getting into that. So for Bank of America, let's say I'm Bank of America. Why would I do this? It's called wholesaling. Right? We talked about wholesaling in chapter 11, right? What I do is I put it under contract, I flip the contract, and I make $2,000-$3,000 just for flipping a contract. For Bank of America, the one that lends to Jane first, I make 1% of the loan, for instance. You guys understand? So if I make 1% of the loan and I flipped it the same day, I made a lot of money that same day. And we're talking about flipping hundreds or even thousands of loans a day. So imagine how much money Bank of America makes. Sometimes, and I'll address that later, sometimes they stay as what's called a servicer, like a property manager. They collect the mortgage over the 30 years and they pass it on to Chase that purchased the loan. So I don't get an immediate fee, I get a long-term fee. I'm a property manager now. You guys got it? So that's what Bank of America will do. To address Daphne's question, which I was going to mention before, on the other end, okay, think about this. I'm Chase now. You got paid. You're Bank of America. You got paid. Me, I'm collecting over 30 years a higher sum that you originated. See, I paid for a future value, not a present value. You guys got it? So if I lend to you $500,000, at the end of 30 years, those 500 are now 800 or 900 or even more, depending on the percentage. You guys got it? Over 30 years. Some investors, and you probably already heard of this on TV, J.G. Wentworth, for instance, it's my money and I want it now. Have you heard of this? Right? What he does, or his group, what they do is they look for people that have structured settlements. That means you have a car crash and they owed you a bunch of money. but they pay you in installments over several years. And now you come into a situation where you need money, similar to this. You need money. Well, J.G. Wentworth knows that you're going to collect $5 million over the next 30 years, but they're willing to give you $1 million today. Now, for you, $1 million today is a big loss, but you need it to do whatever you need to do today. Does that make sense? So what is J.G. Wentworth going to win? It's the long-term $5 million. In a mortgage, is the same thing. You make your quick money today after originating the loan. You make your quick money. Chase is going to collect over several years and sometimes even double the money because of the interest. You guys got it? Give me a thumbs up if you got it. If you have a question, drop it in the chat. And I think, guys, you're going to start understanding why I split this chapter into two. I used to do it all in one day, but split it into two. All right, so you guys understand how changing hands, everybody makes money. One makes the immediate money, the other one makes the long-term money. All right, so Daphne is, any question there? Think also of collection companies. You got the song, right? Think also about collection companies. Let's say you owe me money, right? And you're not paying. 3 months later, what am I going to do? I'm going to sell it to a collection company. Now, am I going to sell for the amount that you owe me? No. I'm going to sell for 6, 7, maybe max 10 cents on the dollar. So you owe me $20,000, right? And I sold it for $2,000, let's say. So collection companies are still collecting on the 20, right? But they only paid me $2,000 for the right to collect. And you guys go ahead and make a deal with them at 60%. Collection company is all happy, right? Because you just gave them a whole lot of money that they didn't pay for. All right, so it's the same scenario. Somebody wins in the immediate, others win in the long run. Correct. And correct. So let me just show you guys, you probably saw it coming through, but let me just show you guys this right here. So to sum it up, this is what it is, what I was saying. The original lender, so Bank of America, gets a fee. Hold on. Now 1 day without a siren. All right, so Bank of America gets their 1% for originating the loan, let's say, and selling it to Chase, right? So they make the 1%, the fee for selling, right? Where the new lender gets interest in the long term, so they get $200,000, $300,000, $400,000, right? And the question was, who pays for this? It's built into your loan, and that's why we're going to talk later about pure interest rate and APR, right? You need to know the difference between the pure interest rate and APR, which is the total charges. Because APR, if the lender already intends to sell the loan, they already built in that fee into your 30-year loan. So yes, you're paying for the whole thing. Absolutely. Okay? All right, so I got to address. Sarah, let me see where Sarah is. I see you just put here a message. Where is Sarah? Oh, right there. Oh, hi. You're closer today. I'm sorry. I was looking far away for somebody shopping for shoes. Never miss a beat, you know. All right. So if you're not able to register, send me a message out of the group, because then it gets flooded in the group and I won't see it. If you need to register, I know a few students are having difficulty registering. PSI is a mess right now. Calling doesn't help. Emails doesn't help. Even I am having trouble getting through to them. So just send me a message separately and I'll address that, okay? All right. Gil, nothing. Vanessa, what are you confused about? It's as simple as, okay, I got you. I think I got you. Hold on. So let's say $300K is the loan, okay? All right, make sure you guys are all paying attention so I don't have to repeat this portion, okay? So 300K is the loan, but then they give you the loan at a percentage, at an interest rate, right? So let's say at 5% for the 30 years, right? And it's a 30-year term, okay? At the end of 30 years, I'm going to show you guys all this in a little bit in the loan estimate. At the end of 30 years, it's not 300K that you're paying. You're going to pay 300 plus the interest. So if you wait the whole 30 years, then let's say instead of 300 is 550K that you paid. That's the cost of borrowing money. It's 200, in this case, $250,000 because you waited 30 years to pay. Okay? So as an example. But that's the originated loan. What am I doing? Origination. Okay? So let's say B of A, Bank of America, originated this loan where they're potentially going to collect $550,000 if they stick to the loan. But like I said, I need money right now. So what am I going to do? I'm going to sell the loan. So what I'm selling is this. It's the $550,000 future collection. So the collection, got it? Of the 550, and I'm going to sell this to I'm going to sell this to Chase. All right? Now, Chase is going to pay Bank of America, hey, thank you for this future interest. I'm going to pay Bank of America, let's say, 1% of this. That's what Bank of America gets paid. So they don't get 1% of the 300,000. They get 1% of what it was supposed to be collected, as an example, right? Or they added a flat fee or whatever to this value. Okay, so this is guaranteed. Bank of America gets this back plus something. So in this case, Chase would get 550 minus whatever they paid Bank of America. Okay? Again, the difference is now versus later. Now I make, let's say, Bank of America lend 300,000, so they get the 300,000 back. And from the fee, they get 50,000 profit, as an example, in that one-day flip, okay? So if I paid 350, I'm Chase now. If I pay 350, how much money am I going to make? Well, in the long run, I'm going to make 200K. That's what it is, guys. Okay? That's how it works. Why, Heather? Because you'd be singing right now? Where's Heather? Hold on. You're back at the house already? Oh, there you are. Okay. So you'd be singing the song? It's not as bad as 1-800-CARS for kids. Anyway. Let's see. Jane, did you see the message? This is why Steven doesn't retain. He doesn't retain information because he wants to make sure there's enough food for him. Jane, if you got enough food to share with the rest of the class, she's dying over there. If you got enough food to share with the rest of the class, Steven is hungry, okay? Let's see. Gary, how important is it to know the different types of loans once you become a realtor? All right, so this part actually is not a different type of loan This part is what happens to the loan after it's originated. Why is it good to know this? In a real estate transaction, doesn't matter for you, at least not immediately. The loan officer must know. But if you get to the point where you're dealing with foreclosures and short sales and all that stuff, now you have an advantage because you know what happens in the back end. Now you know how to negotiate. You know that somebody already got paid. Does that make sense? Just like a collection company. Somebody already got paid, so why are you trying to collect so much? Now you learn how to put pressure on the banks, just like we put pressure on collection companies. All right, so it's just, you don't need it on the daily activities, but if you're dealing with investors, it's great stuff to know. Oh, the Cars for Kids? You got the jingle in your head, Chad, right now? Gil, you can buy any car. You can donate also boats, because they also start with K for cars. And they also say on the radio you can donate your airplane too, because people are walking around with airplanes. So if you have a boat or airplane, you can just do it. Let's see here. Should be seeing. Yep, it is a really bad deal. So yes, Daphne. So they get paid. We can consider it a commission. Yeah. So let's go back here. You can consider this right here instead of a profit. You can think of commission. Yeah. Don't forget, it's a wholesale, so they're just assigning to somebody else and they get paid something. Okay. So you want to think of it as a commission? Sure. It's a payout. You can. Okay. Let's see, Peter. What are the chances that a bank buys a loan from a certain individual, or that mainly happens between banks only? So, Peter, if you're the one that lent the money, there are people that are groups that are note buyers. So, yeah, there's a huge note network around the United States and around the world where people pay for other people's loans. Like, you want to collect right away, it's the same scenario. It could be private, yes. All right, Peter? Next. Jane says, I was not aware that the class could also see me. No, Jane, only those people that are having difficulty retaining information, looking around to see what other people are doing. Yep. Only those people can see what you do. And me. Like a techno video? Yeah. All right. So, everybody good with this assignment that Vanessa was asking? Thumbs up. Give me a thumbs up. All right, good. Perfect. So, let's go back to the book. Now we're going to talk about warehousing agencies. So, if you guys know what a warehouse is where we store, right, a lot of inventory. So, a warehousing agency, these are groups in the secondary market that purchase a lot of mortgages, okay? So the most commonly known are Fannie Mae, Ginnie Mae, and Freddie Mac. We're going to start with Fannie Mae. And Fannie Mae, as I always call them, they are grandma. So it's the oldest kid on the block from these three, grandma. And if you guys know grandma, you guys know very well that grandma talks and the babies listen, right? The grandbabies listen. If the parents talk, nobody listens. But if it's grandma, everybody does whatever grandma says. All right? So why is it so important that you relate grandma to this? Because that's exactly what happens. See, Fannie Mae is a shareholder company operating under congressional charter that provides a secondary market to purchase loans by selling government-guaranteed Fannie Mae bonds at market rates. A lot of fluff here. This is what matters. Mortgage bankers, so remember, mortgage bankers lend their own money, right? Mortgage bankers are actively involved with Fannie Mae, originating loans and selling them to Fannie Mae while retaining servicing functions for which they're paid a fee by Fannie Mae. It's a whole lot of Fannie Mae in one sentence. But what we just explained here, what we just explained here, right? Chase in this scenario would be Fannie Mae. So Bank of America sells to Fannie Mae a lot. Chase sells to Fannie Mae a lot. All right? Because Fannie Mae is the largest purchaser of mortgages. In fact, when Fannie Mae talks, when grandma talks, lenders listen. Why is this important to know? Because Fannie Mae eventually purchases 1 out of every 10 mortgages that are issued. 1 out of every 10. That's a whole lot of mortgages that they purchase. Right? And you probably think, well, 1 out of 10 is nothing. Well, the thing is that there's a lot of groups that buy in the secondary market. So imagine that the other 9 are divided by thousands of groups. Fannie Mae purchases 1 out of every 10. So that Fannie Mae has a higher percentage of purchases. So therefore, control of the market. In fact, loans that meet Fannie Mae guidelines are called conforming loans. What does this mean? So let's figure out. It says here, when Fannie Mae announces that it will buy a certain type of loan, local lending institutions often change their own regulations to meet the stated criteria. Think about it this way. The example I give every time. I'm your investor. I'm your investor. Okay, guys? You're realtors. I'm an investor. And I tell you guys, listen. I'll buy any house on the market. Any. I just have one condition. That condition is that the house must be green. I don't care if it has 2 bedrooms, if it has 10 bedrooms. I don't care if it has a roof or it doesn't. But the house must be green. Guys, how many houses are you going to bring to me? Because I'm announcing I'll buy all of them as long as they're green, right? How many houses would you bring? Let me see what the answers are. Should be easy. Yours is guacamole green. Geraldine, any green. It just has to be green. That's all. As many as I can find. All of them. Joseph, depends on how many cans of paint I can afford. See, what Joseph just said is exactly what happened riding up to 2008. You guys, I'm sorry, some of you don't remember because you were in high school. Okay, I got it. But up to 2008, all the loans were leading towards a recession. Why? Because Fannie Mae says, I'll buy anything as long as it's green. So that means they stated a specific criteria that they would buy, specific criteria of loans that they would buy, right? If it doesn't meet the criteria, they don't approve. Therefore, grammar school. Therefore, what happens is the banks started painting some of these loans green, right? Meaning they would meet the criteria. They told Fannie Mae, no, buy the 1,000 loans that I have here, the package of 1,000 loans, buy it. No loan here is going to default. There are perfect loans according to your purchasing guidelines, all right? So Fannie Mae is the investor that buys from the banks, as an example, okay? You guys got it so far? Okay, I want to make sure I don't lose you because I know it can get complicated, all right? So you guys remember yesterday I said if your buyer gets denied at Bank of America, don't say, oh, you can't buy anything. I said go to a credit union or go to a different bank. You guys remember that? It's going to fall into place today. It's because of this. It's because there's criteria to be purchased in the second market. I want the loan to be from somebody that has at least a 640 or above. I want the loan to be a house that's a 2-bedroom or no more than 4. You see what I'm saying? So there's certain criteria that the purchaser in the back end, there's certain criteria that the purchaser in the back end looks at, and then the bank goes, I'm sorry, Geraldine, you don't meet the criteria. It's not about you, it's really I cannot sell. They don't explain this to you, but that's what it is. They cannot flip the loan to the secondary market. So if they do lend it to you, they're stuck with the loan. And that's called a portfolio loan. They're stuck with it in-house. Bank of America, these commercial banks, they don't want that. Bank of America, Wells Fargo, Chase, they want to keep on flipping because they make quick money. You guys got it? The bank is not in business of holding onto it. They're in business of flipping money. That's what a lender does. Flip money. Okay? So Sarah, that's independent. PMI is on you. It's not on selling in the back end. Okay? So for you to get rid of PMI, you have to refinance or you have to have enough equity. Okay? So whatever the bank will lend to you and drop that PMI. So that's separate. That's on you. Okay? So in the back end, this all happens in the back end. Nobody tells you what's happening in the back end. Who's buying, who's selling. They're supposed to tell you, but they don't. They send you a letter. It looks like all other letters, and you're like, okay, it's just letter from bank, goes to garbage. And all of a sudden, somebody purchased your loan. You didn't even realize that somebody else owns the loan. Okay? Daphne? So right here, going back to, where are you? Hold on, let me see, there you are. So going back to this, right at the top of the page, they're flipping it quickly because they want to keep on lending. And if I make 1% out of 1,000 loans that day, let's say I make 1% flipping out of 1,000 loans, that's 1,000%. Think about it, okay? So why would I do it right away? Because I get paid and, right, I get to lend again, okay? So that's the only reason, is to keep making money. Oh. Let's go back. Too far, let me stay here. If one continues to accidentally pay the old bank, does the bank forward the fees to the new bank? So, Crystal, they're supposed to. They're supposed to. They're not even supposed to accept the money, which could lead you into default. Okay? So, when I'm telling you that it's flipped, that it goes to somebody else, sometimes they stay as a servicer, as a property manager. What does that mean? You still see Bank of America for the next 10, 20, 30 years. You still see Bank of America, but in the back end, they collect it from you and they give it to the new bank. You got it? So they stay as a front, as a servicer. Okay? Sometimes they flip it altogether and let's say it's Chase, they don't use the same servicer, let's say. So now Chase is sending you the bill directly. Sometimes Bank of America will stay sending you the bill from the beginning to the end. Other times, the Chase is the one sending you the bills now. All right? So it all depends on the arrangement. Chad, yes and no. So think about more like a property manager. Don't think about wraparound mortgage here, because a wraparound mortgage is a buyer paying the seller pays the bank. Okay, so the seller of the house. The concept is similar, but think more about a property manager. What does a property manager do? Collects rent. Think about the mortgage payment as rent that's being collected on behalf of the bank. See, in the wraparound mortgage, you're perfect in the idea and the concept, but a wraparound mortgage, there's 3 independent parties. Okay? Where in this scenario, the servicer scenario, the servicer works for one of the parties. So there's only 2 independent parties. Does that make sense? The concept, yes. Money goes to this one and from this one to this one. Yes. All right? I just don't want to get anybody confused about the wraparound mortgage and associate to these mortgages. No. Okay? But I got you with the whole passes from hand to hand. All right, question coming through. All right, I gotta see this. Daphne, you're gonna have to wait. Hold on a second. Where is Heather? Let's see the puppy. Luz says, cute puppy. You guys seeing the puppy? Steven, did you see the puppy or are you just looking at food still? It's a cute puppy. All right, back to, you're the one getting roasted today. I'm sorry. You got 4. All right. So Daphne's asking, the example, Bank of America is the primary mortgage. No, they're in the primary. So Daphne, they're in the primary market. Okay? Guys, keep it to the class. It's not, nothing is for sale in this class except this education, Luz. Come back to class. All right? So, Daphne, can you go more on that being the primary mortgage? What are you trying to ask exactly? I just want to make sure I'm answering the right thing. Because they're working in the primary market because they originate the loan. Fannie Mae, secondary market because they purchased the loan. Okay, so I just want to make sure I'm answering your question. I don't know if you're still typing or Daphne. Okay, you're going for it. Okay. While you do that, I'm going to go for my usual roll call. So, Sabrina, where are you? Okay, Sandra, I see you. Tidy, I see you. Linda, I see you. Meredith, oh, Sabrina's back. Meredith, I see you. Riley, Luz is now focused. Good. Daphne, Vanessa, Heather, and a puppy. Flavio is on the road. Nicole, I see you. Mina Fawzi, I see you. Mina Yusuf, I see you. Funny, I got 2 Mina side by side. Talia, I see you. Sarah in the kitchen. Gary, I see you. Yamili, Brian, Yanessa. Carlos in the car. Chad, got you. Peter, got you. Joe, got you. Gil, Catherine, Natalie, Geraldine, Lena, Moses, Crystal, Jane, Stephen, Anthony, and Perla. I think I covered everybody just to make sure you guys are still on the camera. All right. Heather, you just said Mina Yusef looks like an angel floating over the bridge. Yeah. I don't know if he's an angel, though, but okay. All right. Let's see what... I got you. The halo around his body. Got it. All right, so let's look at question right here. So Daphne says the primary market is BOA. So I was right on the what I was answering then. So Bank of America operates in the primary market. They originate the loan with the intention of selling to Fannie Mae, and Fannie Mae, yes, operates in the secondary market because they're buying the loans. Okay? Just trying to connect. Yep, so you were right on that. Talia, what do you want me to repeat exactly? Sorry, just want to make sure. Meanwhile, everybody's getting distracted with the angel. What I just said this. All I said was what's in the chat right here. You got it? Okay. All right, Luz, get out of the group chat. Stay here. Guys, the more distractions you guys have, the worse it is. I'm telling you, the worse it is. Stay here. Isn't Fannie Mae for FHA only? I'm going to address that right now, okay? So, right here. The next thing we have is Ginnie Mae. I'll address your question in a second. What part does Chase Bank play in this transaction? We just replaced, when I give you the example here, real quick, I just replaced Chase with Fannie Mae. So Chase is not part, when we're talking about Fannie Mae operates in the secondary market, just like Chase in this particular situation. So this could be Chase, could be Fannie Mae, it could be Wells Fargo, it could be a trust. All I was trying to say is that everybody that's on the purchase side are always in the secondary market. Okay? So Chase was a previous example that I put here. What I'm trying to show you is that on the secondary market, it could be any of these. Bank of America, primary market, because they originated this loan. Okay? And then secondary market, whoever buys and pays a fee for it. All right, so going back here, we got Ginnie Mae. Now, Ginnie Mae is the baby. It was created mainly after 2008 because of the whole thing that went through, the crash. So Ginnie Mae is the only one of these three entities that it's government entity. The other two, so Fannie Mae and Freddie Mac, which we'll talk about in a second, they are privately owned, but they are under a congressional charter. What does that mean? It means that since we had to bail them out, all right, now they have a congressional oversight. Somebody's looking at what they're doing to make sure that doesn't happen again. All right? So supposedly, that's what it's supposed to be. This one was created to, as it says here, assist with low income, moderate income, and mainly high-risk mortgages. Okay? So those loans that were dedicated to people like FHA, for instance, they're dedicated to people that are a low, moderate income, right? Or they're risky mortgages because of credit situation or whatever. Ginnie Mae is supposed to be there to help. Fannie Mae purchases 1 out of every 10. Fannie Mae does not discriminate. They'll purchase anything, okay? Ginnie Mae is mainly for this type of loan. And then we have Mac Daddy down here, Freddie Mac, all right? So Daddy here, they buy conventional loans. They're more conservative in the types of purchases they make. So Fannie Mae purchases almost anything. Ginnie Mae is more towards low, moderate income. And Freddie Mac purchases, again, they all operate in the secondary markets. They purchase primarily conventional loans. Okay? All right, Steven, so if I understand this, you want me to go back? All right. Oh, you're saying sorry to go back. Okay. If I understand this right, someone asks for a mortgage. Then when the primary holder of the loan makes it, then they sell it to the secondary market. So somebody asks for a mortgage loan, not a mortgage, because we're the ones that give the mortgage. Mortgage is the house, remember? So we give the mortgage to the bank. What the bank gives us is a loan against that house, against that mortgage. So it's a mortgage loan. So yes, you go to Bank of America and say, hey, Bank of America, I would like to apply for a loan to purchase a house. So I need a mortgage loan. In this case, it's a purchase money mortgage, remember? Purchase money mortgage loan. So at that point, Bank of America approves you, gives you a loan to purchase that house. 2 seconds later, they sell that loan to a secondary market, yes. So Bank of America doesn't come to you and say, hey, Steven, you want to buy a house? Here's money. No, they don't do that. You have to approach them, just like you wrote. You have to approach Bank of America, apply for a loan. They enter into their system, which is the pre-approval, right? It's just to see, do you meet the criteria of the secondary market? If you meet the criteria of secondary market, you are approved. Why? Because Bank of America can sell the loan. Guys, like I said, imagine having a never-ending source of money. which is like me being the investor for you and telling you all the greenhouses. You know you're going to make a lot of money because you can find a lot of greenhouses. Does that make sense? So banks work with secondary market because it's a never-ending source of money. They sell to them, they make money. They sell to them, they make money. So they're constantly flipping loans and making immediate money. Okay? Thumbs up? Okay. All right. Then we have non-conforming loans, right? Now, we've been talking about conforming loans. Conforming loans are Fannie Mae, Ginnie Mae, and Freddie Mac. What does this mean? If they meet the secondary market criteria, as I was saying right now, like the greenhouses that they will buy, or up to a certain amount that they will buy, or up to a certain credit score that they will buy, whatever, okay? If they meet the criteria of these, then they're called conforming loans. Anything that goes against that criteria or above that criteria, these are called jumbo loans, okay? Because they don't meet it. They don't meet the criteria. These are jumbo or non-conforming loans. So can you still get the loan? I was telling you guys, yes. But now you have to look for a bank that does what's called portfolio loans. What are portfolio loans? Well, it's a loan that I don't intend to sell in the secondary market. So if you start with me, with Bruno Savings Bank, let's say, okay? If you start with Bruno Savings Bank, you're going to see me over the next 30 years. We're going to build a relationship over the next 30 years, right? But if you go to Bank of America or Wells Fargo or Chase, most likely you see me for the next 5 minutes. Maybe 5 months, maybe a year or two. But Bank of America lends to you with the intent of selling right away. You got it? Non-conforming loans or jumbo loans, traditionally they stay in-house with whatever bank lent to you over the next 30 years or the lifetime of the loan. All right? Tell me you guys got it. I'm not going to move forward until you guys tell me you got it. Let me know in the chat. Got it. Instead of thumbs up, I want got it. Crystal just says it. Oh, separated. Okay, got it. Daphne has a question. All right, let's see what question comes through. If anybody else has a question, let me know. Okay, what's an example of conventional loans? So on the on Friday, when you guys were talking about FHAs, VAs, and conventionals and all that stuff, a conventional loan is where you go to the bank and you deal with the bank only, without government influence. It's a conventional or a traditional loan, okay? An FHA loan, VA loan, those are government-sponsored programs. So we're looking at the influence of the government when lending to you. That's the difference between these. So conventional loans are the ones that are arranged entirely between the lender and the borrower, okay? What else? Says here, Joseph says, jumbo stays long time, conforming loans are sold quickly. You can think about it that way for the exam, yep. So traditionally jumbo or portfolio loans, these mean the same. Jumbo, non-conforming, or portfolio loans, they all mean the same. These are held for the lifetime of the loan usually without selling to secondary investors, okay? Are there a lot of banks that deal with non-conforming loans? Jane asks. There are. Credit unions, for instance. Small mom and pop type of banks, community saving banks. They usually keep it, they don't sell. So yeah, there's a lot of them. The problem is when we think mortgage, we go straight to the big banks. Big mistake. because they intend to sell. Sometimes it could even be a higher interest rate and you don't even know. Okay? Well, you should know because of what I'm going to talk about after the break. You should know. All right. Yamili is asking, jumbo loan meets the amount borrowing is high? Sometimes yes, sometimes no. Traditionally, yes. The answer to that is yes. A non-conforming loan is called a jumbo loan because traditionally banks will lend to you up to X amount of dollars. And $1 above that is already considered a jumbo. So it could be. All right, that's the easiest way to think about it. For state exam, yes. Okay. Perla, who you got there staring in the camera? I'm charging more. I'm telling you. I keep on warning you guys. You don't listen. You keep on bringing guests into the camera. I charge. Well, tell your stepdaughter that she needs to put some step money into the account. All right, Tidy. Do they have a higher rate like a credit union? Traditionally, yes, because there's different types of insurances. See, a commercial bank is FDIC insured, for instance. I see your son all the time. Stepdaughter, I didn't see it before. So commercial banks, they're FDIC insured, so they're guaranteed. Federal Reserve guarantees them as well, right? It's like they're comfortable, so they can charge lower interest rates. But they're not as flexible, as it says here, they're not as flexible in their guidelines. So they're very strict in the guidelines. If you go to a credit union or you go to a savings and loan association, if you go to something that's more conservative, doesn't deal with these bigger transactions, then most likely interest rate will be a little bit higher, right? But there's the benefit of almost guaranteeing that you're getting that loan, just like I mentioned yesterday, okay? So it's $50 for the stepdaughter and it's $200 for the son. Just letting you know, Pearl, okay? So it's an extra $250. I'm waiting. All right. Let me just take a sound out of here. Question coming through. Yes, I am serious. Yep. So Daphne has a question coming through. Yesenia is like, he's really on a roll today. Still confused about portfolio. They're the same. So Daphne, portfolio and non-conforming are the same thing. So where's Daphne? Right there. Okay. So let's go here. Sorry, just got to make a line in order to move this. And let's say that Fannie Mae says we'll buy loans up to $500,000. So on a single family, we'll buy loans up to $500,000. This is just to make it simple, okay? And you're trying to buy, so Daphne, you're trying to buy something that's $500,000 and $1. Is that amount higher than this amount? By $1. Okay? So this is called Fannie Mae limit. That's the max that they'll lend to you. It's the limit, okay? Because you're asking for something above the limit, this $1 makes it a jumbo loan. Jumbo loan is also known as non-conforming. And where do we find non-conforming loans? How can we get non-conforming loans? We're going to look for portfolio lenders. What are portfolio lenders? They're going to keep your loan in their portfolio. They don't intend to sell it later. They keep it in the portfolio. See, Bank of America, as an example, if they lend this money, they intend to sell to Fannie Mae. So Bank of America is not a portfolio lender. Okay, portfolio lenders would be, for instance, a credit union, right? A savings association and loan association, right? Or smaller lenders. Okay. Jane, yeah. So the thing about credit union, as I mentioned yesterday, these are cooperative banks. So for a credit union, you have to be a member. That's the advantage of credit unions. You're a member, so any profit that they make, they cannot keep. They have to give dividends to the members, so you can earn money actually from the credit union. They only charge you like $5 for you to join, as an example, for you to join the credit union, but they don't keep profits. They put it under dividends. Okay. Can anyone be a member? Every credit union has their criteria. So some of them you have to be like, let's say it's a government, they'll call it like the Navy credit union or the Army or whatever. You have to be a member of the Army, or somebody has to be a family member must be in the Army or in the Navy or something like that. There's local credit unions that they'll say you have to live in the area. There's other credit unions that say you have to be a student, or you have to be this, or you have to be that. So they have their own criteria of who it would be. For instance, let's say I create the New Direction Realty Credit Union, or New Direction Credit Union. Only members of New Direction, whether it's insurance, realty, or anything like that, only members of New Direction would have the opportunity to be part of this credit union. Does that make sense? So credit unions are member owned. So there's a membership, and they determine who's included or excluded from it. All right, and also the types of loans that they would be willing to lend. All right, so going back to Daphne, we're good? All right. I say Daphne, and Vanessa goes like, yep, we're good. Daphne, she answers for you. That's what it is now. All right, so we're good. All right, so we're gonna make that break right now. We're gonna finish early because there's no point in getting to the second to chapter 16. That'll be tomorrow. But I need you guys full attention when we get to this. Okay, so we're gonna take the break now. It's 7:03, so we're gonna come back 7:15. I know I'm giving you a lot of time, but 7:15. Make sure you guys are fully awake. Some of you are still on the road. Some of you are driving. I see some of you are not on camera. I want to make sure everybody's on camera and everybody's paying attention to this one, please. All right? I am not going to repeat it, okay? Heather, what are you eating? Cookies? What is that, pancake? I don't know, I can't see. You're a tiny screen. Toast, there you go. Vanessa says, Perla, your baby is so cute. She still has to pay, Vanessa. Okay? Don't go like with a cuteness and think that's gonna be no. Alright, so I'll be right back, okay guys? Make sure you're wide awake and ready to go. guys, so we are back, and I agree with Heather. Right off the bat, that's what I say. I agree with Heather. If I ran 5 miles, I wouldn't be able to sit. Actually, I'll do one worse. If I ran 5 feet, I wouldn't be able to sit after that. I'd be on the floor. All right, let's see. Oh, the toast, Heather, is with orange marmalade. Got it. Because it was right after the baby, so I don't know if it was the baby with orange marmalade made it cute. I wasn't 100% sure what you were saying there. Question coming? Already? From you? Yeah. All right, so Gary starts with a question. For non-conforming loans, when the first-time home buyer consider getting one, so how would you know what's a non-conforming loan? As a buyer, usually we don't know what it is. As a buyer, you have no idea whether does this conform or it doesn't conform. You'll just know that you're approved or not approved for the loan when you go to a regular bank. So that's why realtors, we are there for the support. We're the ones that are going to say, well, what is the reason why you got denied? You got denied because it doesn't meet the criteria to sell in the secondary market. So let's look at a different lender. You see what I'm saying? So the buyer will not know. And as far as going through the process, it's the same process. You don't make a choice of, you know what? I don't want him to sell in the secondary market. I want to. You see what I'm saying? Buyers don't have no idea what it is. You got it? So it's not even something in the process. Should you know this stuff? The answer is yes, because you need to know, like I said yesterday and I repeated today a couple of times, you should know how to advise your client that if you got denied, let's look at alternatives, right? And most likely you got denied for these reasons, right? So it could be your credit, it could be your income, but it could also be that the type of loan you're trying to get does not meet the bank's criteria for lending. Like there's a lot of commercial banks, Bank of America, Wells Fargo, and so on, that don't give you commercial loans. So if you want to buy a building, a commercial building, it's not Bank of America you go to. Do you see what I'm saying? Because it doesn't meet their criteria. They're difficult to sell in the secondary market. You got it? So things you need to know. It's more about knowledge to also know this type of loan does not go to this type of loan officer. All right? So I deal with different lenders, different loan officers, and some do VA loans, some don't. Some do commercial loans, some don't. Some have some type of association with private lenders, so you'll be able to get a private lending loan for the purchase and then refi later into a regular loan. So that's why you need to create your team of people that you're comfortable with and asking questions all the time. And for instance, go to a lunch, go to coffee, whatever, and ask them as many questions as you can based on the scenarios that you run to. Okay? So a team is very, very important. It's not just you and the realtors around you in your office. A team, we're talking about the title company, we're talking about the attorneys, the loan officers, everybody that participates in the transaction, so you could be able to ask questions. I've asked questions to for instance, just yesterday there was a HVAC guy here, right? And I told him, I just need your opinion because I already had somebody else here. So he understood that I'm not contracting him. I was asking him a question and his opinion. And that's okay. Some of them will understand that they're part of your portfolio of people that you will use or recommend, but they're not the primary. So some of them will understand that. You guys got it? Keep close relationship with all the parties in the transaction. Okay? Ask as many questions as you can. Okay? Vanessa, yeah, after you get your license? Or do you need it now? I mean, okay. Crystal, if a building has a store on the first floor, a living space, yep, that's a mixed use, but it will fall under commercial. There's very few lenders that have similar criteria or close enough criteria to residential lending. Very few of them. Okay, I happen to have a loan officer that will do the mixed use almost as low as down payment as a residential. So, but again, you need to know who you're dealing with for certain scenarios. Okay. Residential is 1 to 4 family. So 1 family, 2 family, 3, and 4. Above that falls into commercial lending. Okay. Good? Ready to go? All right. So, we're going to get into financing legislation. Actually, before I get into this, let me see who's here because I need your full attention. I don't see Moses. Carlos, I see you. You're finally home. Good. Okay, everybody else. Who's not on camera? Who's not on camera? We still have an angel somewhere. Flavio is not there. He just kept me in the car. David, I would recommend, David Gonzalez, I would recommend that you watch this all over again. All right? Because you've been on the road. And I understand what you're doing, but make sure you watch this thing all over again because it gets confusing, especially when I'm gonna go through now, okay? All right. Flavio's getting in the car. Flavio, make sure you watch the replay of this video because it's going to get confusing. You guys need to start eliminating as many distractions as you can because these chapters and tomorrow's chapter, very difficult. We're getting into the end of the course, and some of these chapters can be very difficult. The previous chapters was more like understanding regulations, right? And the rules of being a realtor and what is real estate and all that stuff. Now we're getting to, hey, we're making money. We're talked about putting contracts together. We're talking about financing. Tomorrow is going to be appraisals. So these are the things that you're going to have to deal on a daily basis. But you don't have to know any of this in real life. Like it's not you doing it. But you have to have a general understanding. So if you never did anything with this in the real estate world, it's going to get very, very confusing. I'm pretty sure, and look, I got Crystal. Crystal, you're there. I see you. Crystal, you said you're a loan officer, right? You deal with mortgages. Is this stuff easy for you right now? Is it being easy? Because I know a lot of mortgage people have no idea what I talk about in these 3 chapters. They'll know a few things. Oh, I know FHA. I recognize that one. But they don't know exactly the details of everything I'm going through. So if the professionals have difficulty with this, imagine you guys. Good thing is that you only need to remember the details of this for the exam. But that's the purpose of this class, getting you to the exam. All right? So I recommend that you actually, well, Crystal, what I meant is being familiar is one thing. The other thing is knowing the details. Being familiar better be for you and hopefully for everybody else later. But do pay attention. I cannot stress enough. It gets complicated. Heather. Okay. Let's see. So David, you can find it on YouTube. I recommend either YouTube or go to the site. Try to be in the site as many times as you can because you have more resources there. You got the Quizlets, you got other stuff there. YouTube for me is way better because you're putting the hours, and if I get subscriptions eventually, I'll start making money out of YouTube as well. So it's better for me to push you to YouTube. But I don't care about the money. I care about you getting all the results you can. So go to the site where everything is listed. Okay? But you can also subscribe to my channel, okay? Especially because I'm going to advertise future stuff there. So future courses and all that. So it alerts you every time. Heather, yes. Very unprofessional. Very. Who eats toast with marmalade at this time? Just saying. Very unprofessional. Crystal says, I used to do mortgages. Okay. Daphne says, videos are very helpful on the website. Oh, and just like Daphne told me the other day, there's one of the videos that got cut off at the end. I'm going to be updating those videos to this format, which is a lot clearer as well. So as we go, if there's any chapter where you feel like the video is not clear or the sound or whatever, let me know, because this last session and this session right now, the audio appears to be okay. There's no issues going on, and the image is clear, and the video's been going all the way to the end. I had a big battle with Zoom in the beginning, and still have some issues with Zoom, but I had a big battle with Zoom in the beginning. Everything was dropping. I was freezing on screen, so it wasn't broadcasting. I had to make a lot of changes in my account and software. Even got a gaming PC just for this. So like high-end PC, a lot of money spent into it just to be able to do this. And I still had issues. So I knew it was not me after spending all the money, right? So I will update the videos. The bottom line is, if you have any video there that you see in the student portal, like Bruno, it got cut off. The audio was not good. I could not see this or I could not see that. Let me know, because I am updating the videos as we go. Unfortunately, it's a lot of stuff to render the videos, to produce the videos, to edit videos and all that stuff. So it might not update it on the fly, okay? And some of them I just post directly from YouTube, so it's easier for me. But some of them I want to make sure I start cutting them into sections so it's easier for you to study as well, okay? So just keep me posted on what you go through. Like feedback is great. Yes, so Gil just asked if I'm going to be offering a mortgage course in the future, and the answer is yes. I am actually, it's on my desk, notice to follow up with the national mortgage system, so the lending system, so I can teach mortgage and do CE credits as well for mortgage professionals. Yep. Of my choice. So the unprofessionals, I might not allow them. Okay. So the unprofessionals, I might not allow them. You see what she wrote here? She's the one that posts stuff and goes like, if your students don't post stuff like this, right? Or if they behave. Anyway. All right, cool. So let's go back here. Everybody's paying attention, right? No more moving around. We're good to go. Okay, I cannot stress enough the attention you guys need to have to this. We're going to talk about financing legislation. All right, so a few years ago, I've been talking about this and doing like a layering of the chapters and getting to the point where you need to understand that a few years ago, the market crashed. Okay, some of you were in high school, you don't remember this stuff, right? Okay. So, but the market crashed big time. It was bad, okay? Because of that crash, a lot of things changed. And this is one of the changes that we have from, let's say you had the previous edition of the book. This is one of the changes. What we're going to talk about now is one of the changes that happened. So before 2009, just to give you a quick history of this. Before 2009, you could be a loan officer, right, without going to class. There was no class. There was no fingerprinting. There was no nothing. You want to be a loan officer? You're approved to be a loan officer. What did you do before? I used to deliver pizza. Nothing wrong with that. But if you go from delivering pizza to a loan officer with no training, without understanding anything, then there's a problem there. Because pizza and loans, right? Hopefully you're satisfying people at both ends, like feeding them or providing something that they need towards long term. But one is riskier, right? Because if you don't like the pizza, throw it in the garbage, get another one. Once you get a loan, in your biggest investment of your lifetime, most likely, for the majority of people, if you get a loan, can you just throw it away? No. You guys got it? So back then, that's it. We had to be regulated. We had a license. They didn't. All right? And I was a loan officer for 2 weeks. for 2 weeks. And I'm like, I don't know what I'm doing. How can I be a loan officer, right? I don't know what I'm doing. So I quit, right? Nobody explained anything. Anyway, so pay attention to this. It's very important. You won't deal with the mortgage itself, but you need to know the basics of this so you can explain to your clients what is needed to get a mortgage and what, and this ties in with chapter 21, which is closings. If you understand this, chapter 21 will be easy. Okay? To be a loan officer, Gil? No. Not back then. Now you cannot have bankruptcies. You have to have a good score. You have to pass a background check, so fingerprinting as well. A course, all that stuff. All right, back to this. So we had 3 different forms we're going to talk about in a second, which is the Truth in Lending Disclosures. It's the HUD 1, right, which is the closing statement. And it's the GFE, which is a good faith estimate. All right. So these 3 documents were all the disclosures they gave you towards the purchase of the house. Now, what they did was integrate this in October 3rd of 2015. So it still took them from 2009 all the way to 2015 to figure out we need to simplify this thing. All those years for them to create TRID. So they merged the forms into one. Now, let's talk about what the forms are, and I'm going to show you, give you an example of what TRID now is, or how it plays in your life as a realtor, okay? So we're going to start with Regulation Z, okay? So for high schoolers, this is not Dragon Ball Z, okay? It's Regulation Z, okay? And it talks about the Truth in Lending Act. If you guys remember, the Truth in Renting Act was letting people know the rights they have when it comes to rentals. You guys remember that from chapter 12? All right? So here's the same thing. We're talking about lending. So it's the rights that you have as a borrower and the duties that the lender has, and also rights that they have. Okay? So Regulation Z, you need to associate it with knowing the true cost of obtaining credit. So they have to disclose to you how much is it going to cost to get this loan, right? If you guys remember from before, I said you are borrowing $300,000, right? But at the end, how much are you paying? $550. Okay? You're borrowing at 5%, but is that the true interest? No. The true interest could be, for instance, 519%. This is called APR. So you applied for 5% interest, but the true cost of the loan is a little bit more than that. So every year they charge you 5.19 versus the pure 5%. Okay? So why do we need to know the true cost? Because you need to be able to go compare the cost. And this way you avoid the uninformed use of credit. You need to be aware of all the charges so you can look around, shop around, and say, hey, this is what I got with Bank of America, Wells Fargo, can you beat it? Chase, can you beat it? And so on. You guys got it? Shouldn't you be able to have that opportunity to know if you can get a better rate somewhere else? All right? In fact, until the moment of the closing, you could switch banks if you found something better. All right? You might not be able to close right away, and I'm going to explain that in a second. But at least until the day of the closing, you can always change. After the closing, can you change? No. Only if you refinance. But until the day of the closing, can you get a better loan? Yes. You guys got it? That's why Regulation Z tells you that you have the opportunity to shop around for different loans. And they have to disclose every single cent that loan is going to cost you. Okay, very, very important. Another thing that's very important is that this does not apply to cash transactions, business or commercial loans. Regulation Z applies to the purchase of real estate, and it's only for residential real estate or maybe some agricultural loans. Okay, that's it. For commercial, for cash, for mobile homes and all that stuff, no. Okay? As it says right here, I just mentioned this. Regulation Z requires that the borrower be fully informed of all finance charges. Okay? All of them. Next page. Okay. So I'm skipping all this because I just talked about 2008, 2009. I just want you to see this, that TRID, we're going to repeat this 3 times in this chapter. TRID requires early delivery and disclosures about the proposed loan within 3 business days of the completed application. Okay? Very, very important. We're going to repeat 3 times now, and then when we get to chapter 21, guess what? We're going to repeat another 3 times. Okay? That's how important this is since 2015. It's for you to avoid falling into so having a pitfall like it happened in 2008 or 2009. It's still happening because even though you get the disclosures, nobody reads. Oh, I'm approved? Great, let's go. All right, so nobody reads. Still happens, but at least the disclosures are there. Now, the other thing, right now I have highlighted in yellow, later on it's in green. For a loan application to be complete, you need to have aliens. So complete, you need to have aliens. What is aliens? It's the address of the property, it's the loan amount requested, it's the income of the borrower or borrowers, the estimated property value, the name of the borrower or borrowers, and the social security number. So this will be aliens. Okay, that's the acronym to remember. I'm going to show it later on. It's formatted better. Okay. All the way at the bottom it says there must be at least 7 business days between the delivery of the loan estimate and closing. So between these two, 7 BD, business days. Between loan estimate, and closing. 7 business days. What is a loan estimate? I'm going to go over that in a little bit, but it's the bank telling you this is how much it should cost this loan if nothing changes until closing. This is how much it should cost. Do you agree to this? You say yes. Great. We can go to a closing, but not within 7 business days. So you got to wait at least 7 business days. Okay, that's one of the things that changed in 2015. The other thing we have, I just mentioned to you, is APR. Right? And the APR, the exact cost of APR, depends on complicated calculations, which would be, in the example of 5%, it would be a little bit more than 5%, as I said. In fact, it could be 5.19, and this is where a lot of people get confused, right? Because if I ask you right now, all of you are paying attention, so it's easy, right? If I ask you right now, I go to Bank of America, interest rate is 5%. I go to Wells Fargo, interest rate is 5%. What is the difference between these two? Let me know in the chat. I go to Bank of America, interest rate 5%. I go to Wells Fargo, interest rate is 5%. What is the difference between the two? Sarah goes fine print, I guess. Steven says fees. Gil says fees. What else? Potentially APR, so therefore fees. What else? The years of the term? Nope. Fees, fees, fees. It's the fees that are added to either, if you guys remember before the break, to either carry the loan for 30 years or to sell the loan and be a servicer for 30 years, or to sell the loan and get immediate money for selling the loan. These are all added to the interest. These are the annual percentage rate or interest rate plus charges. You guys got it? So the cost to carry the loan is added to the loan. APR is what you need to know. That's the true cost. So when I said 5%, at Bank of America and 5% at Wells Fargo. At one, it could be 519, the other one could be 524. And you're thinking, well, 0.05% doesn't make a difference. At the end of 30 years, yeah. On the $1 million loan, for instance, yeah. You guys understand? So the pure interest is still 5% on both of them, still 5%. The true cost of borrowing with the different banks is different, okay? So I'm not saying one is better than the other, okay? I'm not saying you don't know who they're going to sell to. No. So I'm not saying one is better than the other. What I'm telling you is pay attention to that. Pay attention to the APR. That's what they have to present to you, okay? They'll tell you exactly how much they're charging in APR and fees. Why? That's why points are so important. Yeah, so you'll be able to reduce some of those. Yep. Heather says, always look at the amortization and see how much you're really paying. That too, but I'm going to show you in the LE. Okay, in the LE, the loan estimate is going to show you all that stuff as well. Okay. Daphne, other than what I said, there's no. The written example is here. There's no way to give you a written example on this, unfortunately. At least I'll have to think about it. But right here, for instance, Daphne, it says right here that the mortgage is 5%, but it requires 3% in prepaid interest points, which we talked about the previous chapter, right? And other fees. So the loan really costs the borrower more than 5%. Okay, so this is what I was telling you guys before. Here, look. So Daphne. So in this scenario before, Chase paid 1% to Bank of America, right? That 1% over the 30 years could be this difference right here that could be this difference. I'm not saying it is, okay? So don't quote me on this. But it could be this difference from 5% to 519. It's the fact that they had to sell and they spread that sale price, that 1%, they spread it over several years. Okay? So that's why they will give you a little bit more. You got it? Okay. I guess the best way I could explain is like right now, for instance, for me to do what I'm doing, I was already doing YouTube Live with my classes. Let's go with this. Yes, absolutely. Before, it's an estimate. A loan estimate must be given to you, so you should know up front. But think about it this way. This class, if I wanted to, I'll be charging you guys an additional fee, right? Because now I'm paying for Zoom, right? So it's something I did not expect, but it happened. And I could put that fee on you. And if you guys look at what a lot of restaurants are doing and stores are doing, they're charging you a COVID fee. I don't know if you guys noticed in your bill, but a lot of places are charging a COVID fee. So depending on the demands, the cost of the class could be the $247, for instance, plus a certain fee. Also, because we're not getting paid cash, we're getting paid all in credit transactions, right? I could charge you a processing fee. So now it doesn't cost you the $247, it costs you $247 plus that fee. So what is the true cost of the class? Does that make sense? And that's what this is. The APR is the true cost of the loan. The interest is 5, but how much does it cost me, the bank, to carry this loan, to service this loan, to pay for employees, to pay for the servicers, to pay for the sale, to pay for whatever it is. They build the cost of that, let's say another $100,000 into it, let's say just ridiculous numbers, and they spread that over the term of the loan. So let's say the term is 30 years, they spread it over the term of the loan. How much does that represent? It represents 3%, let's say, all right? So what is 3% over 30 years. Well, it's 19% per year, 0.19% per year. You got it? So it's the total charge of managing and carrying the loan. Let's see here. So yes, it occurs before the, let me go to the chat so you guys see it. It occurs before signing the contract. It's an estimate, so you need to know upfront to compare the costs. Yes, some places charge you an extra fee for credit card. Yep, absolutely. They pass that charge to you. Absolutely. Some places do. Perla goes, are APRs more or less when it comes to a VA loan? Look, the APR is always more than the interest. Now, in the VA loan, the interest might be less than an FHA loan. But the APR is always more because it's plus fees, plus charges. You got it? So now if you want to compare a VA loan to an FHA loan, that's a different story. To a conventional loan, that's a different story, right? Those are different. And each bank has their own guidelines and how much they charge for a particular type of loan. APR is just, once we figure out which type of loan I'm giving you, how much does it cost to manage? And we add to the fees to the interest rate, and boom, APR. Okay? Moses. New Direction is not charging anything at all. You know that. All right? We don't charge extra. In fact, we charge less than others. But I could have charged more. And no, banks don't provide it. Banks charge it to us, and we technically should charge you guys. So not only did I drop the price of the class, I also have additional charges that are not supposed to be here. I deal with it. But that was a good one. Perla goes, VA loans have tons of guidelines. Of course, yeah. Remember, VA loans, they're giving you 100% of the loan pretty much. You don't come up with out of pocket. You pay maybe a origination fee or something like that, but that's a funding fee. That's what they call it. And that's minimal, right? So if you're getting an almost free loan, yeah, I got no problem with dealing with guidelines. Right? No. All right, hold on. Okay. 5% is not the promo. 5% is the pure interest. Okay, it's what I was telling you. The cost of the class is $247. Period. Okay, so Daphne, that's the cost of the class. How much does it cost me to run the business now that everything changed? Okay, how much does it cost me? I'm going to add that cost to the class. You got it? And that now becomes the APR. So it's the true cost plus APR, plus charges. Now APR is your actual interest rate that you have to pay every year. That's all it is. So the 5% is not a promo. The 5% is the pure interest rate. It's the true cost. It's the pure cost of it. Plus other fees, you get to the APR. Chad, like a college course without all the fees. Yeah. Or when you go buy a car. When you go buy a car, they tell you it's $15,000. You get out of there with $30,000 loan. Why? Because they added it was a tough to get this loan fee, right? It was, hey, we had to check your credit twice. Like all this other stuff, and you put down payment, but you still come out paying more than whatever you put down, right? So that's what it is. It's the plus, plus, plus over the years. All right. You good, Daphne? Okay. On the right-hand side on top, it says 3-day right of rescission. What is rescission? Right above rescission, I want you to write cancellation. Cancellation. I know it says right down here, it says rescind or cancel, but rescission, cancellation. So you have 3 days to cancel, right? You got 3 days to cancel the loan. Okay, and it says right here, it's 3 business days. I know they don't put it. Something that gets people confused when they study. Right? That's why I keep on writing business. I keep on writing business everywhere. They say 3 days, 5 days. Keep on writing business days so you don't get confused. So you got 3 business days, right? Including Saturday because it's banking. Banking is open on Saturday. You got 3 business days to cancel the loan. Now, when can you cancel a loan? When the loan is not the purchase for the purchase of the house. So, does not apply to residential purchase. Okay? The 3-day right of rescission, it's only for refis. Okay? So you already have the house. And you're like, hey, let me refinance so I can drop the interest rate so it's lower. Or let me refinance so I can cash out. Whatever the reason it is you're refinancing, right? From the day you close on that loan after you purchase it, right? From the day you close until 3 business days later, you can call the bank and say, hey, you know what? Take all the money back, cancel this loan, I don't want it. Within the 3 business days. From the day you close and till 3 business days later, you can cancel the loan and return everything, go back to your original loan. Okay? But this only applies for refinances, not for residential purchase. When you buy a house, you buy a house. Remember I said earlier, until the day of the closing, you can switch. Right? Remember I said that earlier? Until the day of the closing. Because once you close on the purchase of a house, once you close, that loan stays with you unless you are able to refi into a new loan. Questions? Daphne, it depends. How much are you refining for? If you're refinancing, let's say you borrowed $500,000, now you owe $200,000, but you want to drop the payment, you can refinance just the $200,000 to a lower interest. Okay? So you don't have to touch your equity at all. You can just refinance to a lower interest, so you don't lose it. Okay? Good? All right, so next thing is advertising. Okay. So we don't do advertising of mortgages. Loan officers do. So you're probably thinking now, why do I need to know about advertising then? Well, because a lot of times, and if you guys are smart, you're going to do this. A lot of times we partner up with loan officers, right? We partner up with loan officers so we can go 50-50, which is the maximum that they're allowed to contribute towards your marketing. Okay? So we're going to go 50-50 on the cost. For me to do 1,000 flyers, it costs me, let's say, $200. You pay 100, loan officer pays another 100, we're good, 50-50. But why would the loan officer do this? If there's no promise, there's no guarantee that the buyer will use them, right? So why would they do that? For exposure. Well, how do they get exposure if you're advertising the house? They're going to include a portion of that flyer. They're going to include their information that says, buy this house for only $1,400 a month, for instance. You guys understand? So their info is now on your flyer. You got it? Good so far? Great. So here's the problem. First of all, you must be stated, if you're advertising financing, the APR must be stated. That has to happen. Regulation Z, which is the Truth in Lending Act, we just talked about it earlier. What is Regulation Z, right? Applies to all credit advertising, not just for mortgages. It applies to all types of credit. So even credit cards, car loans, it applies to all of them. And it has something called triggering terms. All right, hold on. Is somebody just dropped? All right. All right. So, what I was saying, you got triggering terms. What are Yeah, it was Perla. I just saw the message. Yep. Thanks, Joe. So, what are triggering terms? As the name says, it's something in your advertisement that will trigger the regulations and subject you to fines and penalties, okay? So triggering terms, it triggers the penalties because now you're in violation. So triggering terms are the amount or percentage of down payment, number of payments, amount of any payment, and amount of any finance charge. If I make a statement on any of these, if I make a statement, not opinion, statement, I'm telling you this is how much you're going to pay. I'm telling you this is how much is going to be your interest rate. This is how much are going to be the finance charges. The moment I make a statement, it triggers additional disclosures, okay? So here's an example. Full disclosure would be necessary if any of these terms were used. 30-year loan available. Might not be, it might be a 15 only, okay? Payment of $1,432 including principal and interest, or only 5% down. Guys, I usually get stuck on this one. $1,432. Let's go to the chat, and I want to ask you guys, please work with me on this. It's very simple. Do we all qualify in the same way? Let me know. Do we all qualify in the same way? Good. Do we all have the same income? Now, do we all have the same credit? It doesn't stop. It's like a waterfall of no's, right? Okay. Do we have the same job? Do we live in the same area? Do we have the same household? Family amount of people in the household. Do we have the same? No, 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 and no. Yes, Crystal, you're right. No, 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 and no. So because everybody, Gary, don't say no to all future questions because you don't even know what I'm going to ask next. Ready? Do you guys agree that we, see, turning into a positive now. Do you guys agree that we all have different fingerprints? Go ahead, Gary. Say no. All right. We all have different fingerprints. In this case, guys, we're talking about your financial, even if you're twins, you're talking about financial fingerprint. Everybody has their own financial fingerprint. We can have the same score, but different DTI ratios, right? We can have the same income, but different family, so different household size, okay? So there's a lot of differences, different jobs, different everything. So that's why I cannot promise you in any of my advertisements, I don't care about a loan officer does, but if he does it on my advertisement about this two-family that you're about to go see, if he makes a statement like this, then this is a triggering term because everybody's different. If it's a triggering term, then we need to include a few more words. To a qualified buyer. Or these numbers were based on a 720 score with a $120,000 income and so on and so forth, right? So triggering terms require more disclosures. Pay attention because this is almost guaranteed question in the state exam. What does not trigger the disclosures? Financing available. Am I guaranteeing you anything with financing available? No guarantees, right? No statement. Financing available. Do you qualify? I don't know. Terms negotiable. Am I guaranteeing any negotiation? Am I telling you if you negotiate down $5,000, they'll approve it? No, I'm just telling you it's negotiable. Do your best. Owner may finance. Is it guaranteed they will finance? No. Assume a 5% annual percentage loan. If there is one and it's assumable, then you might be able to assume the current loan. Attractive financing. What am I telling you? Nothing. Right? Or a $400,000 mortgage available, but I'm not telling you how much the interest rate is or how much your monthly payment is going to be. You guys see the difference? So these are liberal terms. It's nothing specific. You guys got it? The moment it's specific, additional disclosures. Like Joseph just said, like every car commercial. To qualified buyer. Yep. All right. Good. All right, so going to the next page, penalties. Because if you guys did not understand what I said, if you guys don't understand what I said, then understand this. Penalties. The violation is $10,000 for each day that the violation continues. Go ahead, give out flyers. Don't pay attention to what you're putting on that ad or what the mortgage guy is putting on the ad, right? Don't pay attention to it and just give out 1,000 flyers, 10,000 flyers. How fast can you get all those flyers back? You see what I'm saying? So you got to pay attention to the marketing that you guys are doing together, because even though he or she is the one that has the license for mortgages, applies to all credit and you're part of it in that advertisement. So you're liable too. You got it? Questions here? No? All right. And there's more. Like, there's more fees, there's more fines, all that stuff. Just focus on the $10,000. If anything, that's going to be the question. All right, the next one we have. All right, hold on. Joseph has a question. There's prison too. Yeah, could be. Joseph's asking, does this apply only if they're advertising on your flyer? It applies to you if they're advertising on a flyer. If they're advertising on their own, right? It could be for the house that you're trying to sell, but if they're advertising on their own, does it affect you? No. But if you're doing joint advertising, does it affect you? Yes. Okay? All right, so the next one is RESPA. RESPA. And RESPA is Real Estate Settlement Procedures Act. Okay? What do you need to remember? The previous one was Truth in Lending Act. So Truth in Lending is about the cost of financing. RESPA is the cost of settlement. It says right here. And this, again, only applies for residential, and it's only at the time of purchase. Okay? At the time of purchase. Just like the Truth in Lending Act, Regulation Z, it only applies to residential purchase. Notice how I have things highlighted, right? You guys got it? What is the cost of settlement? Well, closing costs. So not only do you need to know how much is the loan going to cost you, how much you need to come up with up front, right? And how much you're going to pay all the way at the end, but you also need to know at the day of closing, how much money do you need to bring? What is the true cost of closing? And this goes both for the seller and the buyer. This one is for both. Okay? Give me a thumbs up if you're good so far. Okay. So here's what happened. The same way some of you might be confused, like, so there's TILA, Regulation Z, there's RESPA, and then there's another form I'm going to talk about. Why all these forms, right? The same way you're confused, a lot of people were too, especially in 2000, up to 2008, 2009. So what they did, as I was telling you before, is they merged all these forms into one. We now call this the TRID disclosures versus Truth in Lending and RESPA and this and that. No, it's just TRID, because now it's the integrated Truth in Lending and RESPA disclosures. So when you hear TRID or when you see TRID, you need to remember that they merged the forms. Okay? So what forms am I talking about? They used to have, I'm going to show you in a second. They used to have HUD-1, GFE, and TILA, as I said earlier, right? HUD-1, GFE, and TILA, 3 forms. Now it's one form. It's called loan estimate, and then at the end, the loan estimate is now called closing disclosure. It's the same form with the final costs, okay? What you need to know is that TRID only applies to residential purchase, remember? So it does not apply to HELOCs, so lines of credit, mobile homes, reverse mortgages, cash transactions, or commercial purposes. It only applies to residential purchase. Okay? All these rules are for residential. You go commercial, there's no rules. It's like you can do whatever you want. Almost like that, okay? So remember, everything is about residential. And these are the forms. It used to be called HUD-1, which is a settlement statement. GFE, which was the good faith estimate. So that's the lender telling you that they're acting in good faith. And these are the costs of the loan. So they would give you that on all separate documents. And then you have a separate document called TILA disclosures, right? So this was based on Reg Z, okay, Regulation Z, which is, hey, go shop around, okay? But these were separate forms, separate disclosures altogether. Now they merge the forms into one. So Gary, would this be presented at closing? Yes and no. This is presented before anything and then after everything. So when you apply for a loan, they have to give you this. In fact, since you asked, they give you the loan estimate and you must agree to the terms and intend to proceed. If you agree to the terms and you intend to proceed, now they charge you the fees that they're supposed to charge. See, before you agree to it, they can only charge a credit report fee. After you agree to the loan estimate, they can charge additional fees like appraisal, application, and so on. When is a loan complete? When do you get the LE? Once you have address of the property, loan amount, income, estimate, name, and social. Aliens. The application is now complete. Okay? The application is now complete once you have aliens. Once you have aliens, within 3 business days, they have to give you the LE, loan estimate. We're going to repeat all this right now. Look, Gary's right here. So since October 2015, so October 3rd of 2015, lenders are required, this is the second time we're talking about this, we're going to repeat one more time, and then chapter 21, we repeat it 3 times again. Lenders are required to provide the loan estimate, which we call LE, within 3 business days of loan application. What is the LE? It's an estimate of charges for you to be aware how much does it cost. So let's figure out what an LE is. Right here, it's on page 213. This is a sample loan estimate. Get familiar with it. All right? Now here's the thing. Do we need to know everything that's here in detail? No. But because you're sitting down with your client that's going to buy a house, should you be able to advise your client, hey, look, there's this charge, there's that charge, everything's disclosed right here, right? Should you? Yes. And guess what? At closing, you're going to have a document that's very similar to this. It's called now closing disclosure. So Gary, that's the one that's given at closing. This one is right in the beginning, within 3 business days of a complete loan application. And what do we have here? Look. It tells you the bank that's giving you the loan. It gives you the loan estimate, the property that you're trying to buy, the sales price, okay? So the property, the sales price. It tells you how many years, what is the purpose, if it's a purchase, if it's a refi, whatever it is. It tells you if it's a fixed rate or adjustable rate, so the ARMs, right? In this case, it's a conventional loan. It's not FHA, it's not VA, okay? The rate is locked, so you get to know this up front. It's locked until April 16. If you want to extend, you might be able to, but it's locked until that day. The loan amount is $162,000. That means you came up with a down payment for the difference. The interest rate is 3.875%. This is all given up front, guys. Up front. How much you're going to pay every month? $761 principal and interest. There's still taxes and insurance missing. Can these amount increase? In this case, no, no, and no. Why? Because it's a fixed rate loan. Good so far? Okay. It tells you if there's a prepayment penalty. In this case, yes. Not in New Jersey though. But in this case, it says yes. As high as this much. Is there a balloon payment? It says no. There's no balloon. So this is a fully amortized loan, if you guys remember that. Okay? Now, we know it's $761 for principal and interest. So now it shows you the estimated cost with taxes and insurance. Your total estimated monthly payment should be $1,050. Mr. Buyer, do you think you can afford this? If so, we can proceed. If you like, you can still shop around to see if we can get a lower interest and maybe a lower payment. You understand what I'm saying? This is all given up front. Okay? Up front is given to you. It also lets you know that this can increase over time, the taxes, insurance, assessments, because that's out of the control of the bank. And then the key, what we need to know up front is this, guys. That's why I tell you, in chapter 21, I'm going to teach you how to calculate this stuff. Okay? But if you don't want to know how to calculate, it tells you right here, up front, how much you're going to pay in closing costs. It also tells you, you got to bring $16,000 to close. All right? So if you put already, let's say $5,000 as a deposit towards the contract, this is the balance you need to bring at the day of the closing. So you can tell the client, be prepared to bring $16,000 the day of the closing. Or you can go to the seller and say, hey, Mr. Seller, would you consider, in the offer, would you consider contributing $10,000, $15,000, $20,000 towards the closing costs? So sometimes you can get the seller to pay for this. You guys understand? But now you know how much it is. All this is given to you up front. Not to you, the realtor, but to you, the buyer. You, the realtor, should be able to look at this and tell the buyer, hey, Mr. Buyer, this is what you need. Our job, consulting job, is to provide this stuff. Okay. So Crystal, yes and no. If it's within 30 days for mortgages, it's like having several inquiries on your credit. If you get approved for one, it doesn't affect you as much. If you don't get approved, yeah, it will hurt you. So obviously here you got approved for something, because otherwise they wouldn't give you this. So you're just shopping around. As long as one goes through, it's a new account. So whatever it drops, it will increase right away. Mina Fozzie, are you okay? You look like you have a headache here. You okay? All right. You know what? I don't need to call Mina Fozzie and Mina Youssef. I call Angel to one, and the other one is like the headache right now. He's like this. Oh my God. What did I get myself into? Okay. Oh, Gil just replied to you. I'm sorry, I didn't even see that. All right. Daphne, question coming. Yanessa, if the seller says, how would I read this? You're talking about purchase price, right? I just want to make sure I'm reading this correctly. If the seller pays the purchase price, that's what you're saying, you will increase the purchase price, right? So yes. I just want to make sure we're clear. Two words together that don't go right. I mean, all right, Daphne, you had a question, and the difference between closing costs versus cash to close. What does cash to close include, like fees? Okay, so let's go here. So there's something called down payment, right? There's something called so the good faith deposit, right? And then there's the closing costs. All right? So we have down payment, we have good faith deposit, and we have closing costs. The good faith deposit, actually let me change the order here so it's easier. So good faith deposit, down payment, and closing costs. Let's put it like this. So the good faith deposit is you said, hey, I really want this house, so here's $1,000 with the offer. Okay? So you put $1,000 towards the purchase. 2 days later, so let's say we concluded a turn of review, you put another $4,000, so that's called second deposit. Okay? So here's a total of $5,000 already. You with me so far? Yep? Great. So now there's something called down payment. Down payment is the difference between the loan amount and the purchase price, the PP, right? So now that you have the down payment, let's say the down payment is $20,000. Let me put a different color. $20,000 is the down payment. Because you already put $5,000, how much down payment do you need to bring at closing? So minus 5,000, you still need $15,000 down payment at closing. See, the good faith deposit is contributed towards, or put in reserves towards the down payment if we close. All right, if we don't close, you get the money back, maybe. If we do close, then the deposit goes towards the down payment. Closing costs in this scenario that was there, closing costs were $8,000. Closing costs. So you gave $5,000 up front. That's a good faith deposit. Now we get to the closing table. How much do you need to bring? Well, you need to bring the $15,000 balance of the down payment plus the $8,000 in closing costs. So $23,000 cash to close. Got it? Okay, give me a thumbs up. Let me see everybody thumbs up if you got it. Great. Daphne, no thumbs up? Oh, you got it. Okay. Everybody else? Good. All right. So that's what it is. And Yanessa, the answer is still yes. The purchase price increases if they're contributing towards the down payment. Yes. I know you're doing it on purpose. All right. Only because I gave you hell earlier, I know. And she says, that's right. Okay. Mina, can you negotiate, Angel, I'm sorry, Mina Angel, not Mina Fozzie, okay? Can you negotiate the closing cost? Closing costs are closing costs. That's, we're going to talk about later, that's recording fees, that's realty transfer fees, that's appraisal fees, that's a bunch of fees that are involved with the purchase, okay? So can we negotiate that? Most of the times the answer is no, because these are set fees by the government. Whatever's independent, like title company, can you negotiate that? Sure. Give it a try. Okay? Attorney fees, can you negotiate that? Sure. Give it a try. So you can tell the seller to contribute a certain amount towards those fees or pay all the fees. That depends. That's the negotiation is with the seller. All right? But if it's seller's concession, yeah. So, but if it's a municipal charge, like recording fees, $35, taxes that need to be paid that are pending. Realty transfer fees, recording fees, like I said, all that stuff, these are set fees. There's nothing you can do about it. Okay? You can negotiate who pays them. So in this case, well, the buyer's still going to pay it. It's just we're asking the seller to credit towards the buyer. So it still comes out of the buyer's account, but the seller's the one transferring that money. So it's a seller's concession. All right. So let's look at this because again, you guys need to understand how the closing disclosure, the loan estimate works, which is very similar. You're going to repeat the same thing in chapter 21. And I hope you guys can understand why I'm going so slow in this chapter, why I broke it down into two parts. It does get complicated. It's easy once you get it, but it does get complicated. So closing costs. This document shows you how much you're going to pay. See application fee, points right here, 0.25% in points, underwriting fee, taxes, so the recordings we were just talking about, insurance, mortgage insurance premium, so MIP, prepaid interest, everything is in the closing. So the estimate must include all these fees. Okay? Title policy, appraisal fees, credit report fees, flood determination fees, tax fees, fees. All the fees are here. Okay? Everything is here. And then you get the total loan cost. You get the estimated cash to close right there, $16,000, but you already gave, I'm sorry, it's $18,000 plus the $8,000, but you already gave $10,000. So that's the deposit. How much is left to close? $16,000. So everything is right here in this document. If you tell me, if you come to me and say, Bruno, how much do they need to reserve towards closing? You know, look at this document. It tells you right now. That's how much. Okay? Okay, what else we have? Right here. It also has the tip that you pay the bank. Tip is the total interest percentage. That means if you're borrowing $100,000, they keep $69,000 on top of that. So $100,000 borrowed at the end of 30 years is $169,000 in this case. Okay? Do you guys remember how much was the interest rate in this loan? It was 3.875. How much is the APR? You guys understand? Okay, so the APR is the true costs. So right here, costs over the loan term expressed as a rate. And it says, this is not your interest rate. This is the loan costs. They are right here. You see right here, loan costs, mortgage insurance, all that stuff, divided by several years. Okay? It tells you also, can you assume this loan? Yes or no. So that means, can somebody else take over your loan, if you guys remember that? Yes or no. The late payment fees, will there be a servicing? Look right here. We have all these terms from today, right? Will there be a servicing? It says, we intend to transfer the servicing of your loan. That means they're saying they intend to sell it in the secondary market. That's why you see this big difference. Going back here. From this to this, look at the huge difference. Okay, 0.5% almost. You guys got it? Why? Because they're selling, and yes, you're paying for it. Right here. We intend to sell your loan. That's what it is. It's going to cost you. And by the way, I have some people here that are licensed, and I'm pretty sure a lot of this stuff you don't even know. You just went like, wow, it was there all the time, right? And I can tell you that the majority of people don't know. I know it because I have to teach it, right? And I know it because as a buyer and as a seller, I need to know these things, right? So over the years, you get to know it. But most people do not know. We're now on page 217. Look where it says, guys. Under the TRID rule. Under the TRID rule. What is TRID? Truth in Lending, RESPA, Integrated Disclosures, right? TRID ruling. Lenders are held to a good faith standard in disclosing fees and changes. So they have to give you a projection of the actual fees, an estimate. And it shouldn't be much different from that at the end. If some things change, then if there's changes, then they must reissue a loan estimate. And every time they reissue a loan estimate, there's a new 3-day waiting period. So what am I saying here? We have a closing tomorrow. There's a closing tomorrow and something changes to the loan. Are we closing tomorrow? We just said no. We got to wait at least another 3 business days. Okay? Right here. Business. Always business, okay? Sorry, let me clear this. It's just that this is very important, not only for exam, but real life. This happens. We expect to close tomorrow. Everybody's happy. We're closing tomorrow. We're making money. We're going to walk away with a big check, $10,000, right? But there was a small change in the loan. Are we closing? No. And guess what? Realtors get so disappointed. A lot of them even go like, real estate is not for me. Why? Why isn't real estate for you? Because you have to wait another week to make $10,000 on something that you worked maybe 10 hours, the whole thing in total, right? That's $1,000 an hour. Why isn't it for you? So a lot of realtors, I'm giving you the heads up, a lot of realtors get so frustrated that they don't close right away. They're in the high hopes of closing right now. But that's your mistake. When you start saying, oh, I put it in the contract, I closed, I sold this house. No. Do you know how many realtors say that? I sold it, and they just put it in the contract? In fact, it's still under attorney review, which means it could drop at any moment. So you put it in your mind that you closed, and you get to the day of the closing, there's nothing. Disappointed. Okay? Gotta remember this. If there's a change in the loan, it's another 3 business days to wait. And 3 business days on a Friday means next week. Like the end of next week or maybe the one following. So you just lost a whole week. So what could change the loan? What could change the loan? You, the buyer or the borrower, requested a change. Meaning, hey, you know what? I was going to go conventional, but I want to go FHA. I want to take advantage of the FHA now. Okay, you changed the loan. Got it? The other thing was, appraisal is different than the purchase price. It appraised lower. You have to come up with more money. It appraised higher, so we have to recalculate everything. Okay? Sarah, no, when it comes to banking, Saturday is a business day. Sunday, not. But Saturday, yes, when it comes to banking. Again, here, change the circumstances that affected the application. Like, for instance, you got a new loan. You needed a new car. You're approved for $400,000 house. What's a $40,000 car, right? Remember this? We talked about this yesterday. It affects your purchase price, DTI ratios. You missed a payment, 30 days late. Credit drops. Let's look at this again. So it changes the loan. Lender could not document your bonus or overtime. State exam question, by the way. I know I don't have it highlighted, but I'm giving you a heads up. If they could not document the income, then how can we prove that you can purchase with this loan? Right? You're telling me you make $10,000 a month, but that's including bonuses and overtime and all that stuff. If you cannot prove to me that you make that extra money, then you're not approved. You're approved based on the lesser amount. This all changes, okay? Again, interest rate changed. Why? No rate lock or it expired. Prepayment penalty was added. Well, in New Jersey, you cannot have a prepayment penalty, so this must be removed. Right? Must be. So it changes the loan. The loan product changed. We just talked about that. Or APR went above the allowable limit. If you guys noticed, you don't need to remember all this stuff, okay? What you need to remember, if you guys noticed, is that a new LE needs to be issued if loan terms change. So write somewhere, a new LE or new loan estimate must be issued if loan terms change. It's very simple. If the change right here was not related to the loan, like unexpected discoveries during the walkthrough, like, oh, there's a hole on the wall. Does the hole on the wall behind the furniture that was there, does a hole on the wall change the loan? No, it's just an argument for closing purposes. Mr. Seller, I didn't know there was a hole. So now it costs $2,000, $3,000, $4,000 to fix it. You need to credit that at closing. Does that make sense? It doesn't change the loan amount. It changes the negotiation at closing. Here's another one. Necessary changes at closing, such as commission, tax, utility prorations, right? Or escrow. Escrow is taxes and insurance. Do these change? Any of these change the loan? No. So guys, when you're looking at the question, if it does not change the loan, then it does not trigger a 3-day period. If it changes the loan because there's no way to document income, because it's a different type of loan program, because you requested a change. If it changes the loan terms, then yes, it will trigger a new LE. Got it? All right? If there most likely is a question there, it's either going to be about not triggering, right? It will say something to which one of these or all of these will not trigger except, right? If there's one that talks about loan changes, that one will trigger. So that's the answer. All of these will not except. You got it? That's the way they will do the question here. Next. So Gary, I was explaining this before. You're going to have the LE up front. So you are responsible as a borrower to compare the LE to the CD. What is the CD? Closing disclosure. Okay? Gil, not compact disc. I know this back in the day you used that. Now it's MP3s and stuff, right? But, right, we don't use CDs anymore. Did you use vinyl when you used to DJ in the beginning? Did you ever use vinyl? I learned with vinyl, and then we moved on to CDs, but I learned with vinyl. Eight-track. Jeez. Oh, you only started in 2006. Got it. I started at 15, so way before 2006. 8-tracks. Tapes. we'll use all that. Sure. Cassettes. How about VJing with VHS? Anyway. All right. See, I knew I was pausing for a reason. Great. Okay. Hey, Daphne, I don't see a question mark anywhere here, and you were typing something, okay? Just letting you know, big no-no, okay? All right, so on an LE, is it more important to look at APR than interest rates? Of course, because the APR is what the actual charge of the loan is, yes. So APR, always. I don't care about the interest rate. I just showed you, 3.875 was the interest rate. But the APR, the true cost was 4.275, so way higher. Makes a huge difference at the end of 30 years, that half percent. Gary says the Walkman. That was good. Sure, absolutely. We'll do it one day. Chad says, I have a radio that still has an 8-track player. Let's go for it. I don't care. Music is music. Love it. All right. If it still plays, Chad, we'll do it. So we'll put an 8-track and then Gil and me DJing. That's the deal. All right. At Jonathan's house during the barbecue once he does his first closing. Boom. He's not here to hear this, but we just made it the whole arrangement. All right, next. Business days. So you're asking me about Saturday in this scenario. So yes, guys, there's two definitions for business days. Now, business day, usually it's Monday through Friday. So if you're dealing with contracts, because attorneys are not required to be open on Saturdays, and because City Hall is not open on Saturdays, and because most municipal locations are not open on Saturdays, for those purposes, Monday through Friday. For banking purposes, if it's a loan that we're talking about, then most likely they are open on Saturdays. So definition of business day is any day that the lender is open. So it could include Saturdays. They might or might not be considered depending on the lender. Got it? Loan estimate. We talked about this already. What is the loan estimate? Is you being able to tell upfront how much it's going to cost you. When does the creditor, so lender, have to give you the loan estimate? No later than the 3rd business day. Did not tell you we were going to repeat this? Right? 3 business days. Yeah, I see you, Heather, right there. I see it. I don't know if it was the white power sign or if you're saying 3. I'm not sure which one it was. Too soon? All right. Now, 3 business days of receiving the loan application. We're going to repeat this again. Look, there must be at least 7 business days, between loan estimate and closing. So delivery of loan estimate and closing. We said this before, I'm saying it again. 7 BD, 7 business days between loan estimate and closing. I see it. She keeps on going. In a little bit, we got West Side. We got, I don't know what you're going at right there. Gang signs coming up too. Heather, seriously, you got to stop. The 8-track was enough. All right, ready? One more time. The CD must be delivered at least 3 business days before the consumer signs the loan. So usually at closing. Luz, I don't have my eyes on Heather. It's right there. And she's always doing something, so it's easy. Chad makes the comments, she makes the faces and stuff, so perfect relationship going on there. All right, so pay attention to this, guys. We talked about LE, 3 business days from loan application, but we cannot close within 7 business days of LE, and the CD must be given at least 3 business days before closing date. Okay, so that's the timeline. So if you guys put it all together, we're looking at 2 weeks, calendar weeks, before we can actually close. Now, don't be too worried about that, because for you to close in 2 weeks, it has to be the best deal ever, the stellar clients, the stellar seller, buyer that have everything in order, everything lined up. At City Hall, there's no issues in giving you COs and all that stuff. So you are not closed in 2 weeks. If you do that, then that's a unicorn. Okay? Okay, it barely happens. Be prepared for 3 to 4 months. If you close in 1 to 2, which right now is the average, 2 months, right? If you close in 1 to 2, then you're okay. But if there's delays, you already put in your mind 3 to 4 months before I can collect that check. You guys got it? Yes? Great. Crystal says, could these be electronically now? Almost everything is electronic now. Almost everything. But it still takes the same time. You still have those 3 business days up front and then before you close, and the 7 business days within. The problem is everything else. The inspections, the CO, making sure they don't buy a car, making sure they don't change jobs, making sure the seller doesn't destroy the property right before leaving, right? So these are the only things that could take a little bit more. So Chad, you just wrote anything can happen within 3 or 4 months. That's the reason why I'm telling you to put in your mind 3 to 4 months, because anything can happen. You might not even close. In fact, most deals you will not close. So that's why you got to have a lot of deals in the pipeline, so that every month you have a closing at least. Okay? Some will fall through, some will go through. The benefit is we work very little for the compensation. We work very little. So compared to a job where you work 8 hours a day, right? So, and when I say I'm not saying that this job is easy. What I'm saying is that once you have everything lined up, once you understand the process, it becomes easier and easier and easier if you're dedicated to that. Okay? Especially if it's at, oh, FHA, forget about it. Yep, absolutely. Gary just said, my mom said, yep, she's there? She is? Tell her I say hi. Anyway, all right, guys, so we are done. Summary, we're done for today. Do you have any questions? If you guys want to stay and ask a few questions, then I'll address it. If not, then it will be for tomorrow, 5:30. Vanessa, penalties. Oh, Vanessa, the penalties is if somebody advertises. Good night, guys. So if somebody advertises like buy this house for $1,400 a month, everybody qualifies in different ways, right? So if somebody advertises this house for $1,400 a month, that's a violation of the regulation Z. So you have to pay $10,000 if you get caught. It's $10,000 a day that the violation continues. So that's what it is. Okay? You got it? Okay. Any other questions? Whew. She's been typing since 6 p.m. All right. Hold on. Right here. So regarding restrictive covenants, different chapter altogether. I've been perusing houses in Putnam County, New York, and some houses are pretty cheap for the area with acreage and raw land. And this is 200, 300. However, there are restrictive covenants governing the purchaser must join a country club where the initiation fee is $25,000 and the yearly fee is over $10,000, or the house has to be over 20. Is this legal? Absolutely. What is illegal is for me to say that you can only, the buyer has to be from a particular religion, or it has to be from a particular country, or it has to be from a particular color. Those will be restricted. Saying that you cannot sell the house after, that's a restriction. That's illegal. Less than whatever the township allows, that's illegal. But putting this restriction, that means that the house, the people, the subdivision probably is part of a club. So, or part of the community has a country club there. So they want to make sure that everybody's within the same organization, let's say. So definitely okay. Being over 2,500 square feet, we talked about this in chapter 9. Yeah, we can put those restrictions. The subdivision could restrict you to that. Absolutely. Okay. Wow, you saved it. You saved this in the Word doc just to copy and paste? Smart. Hey, Daphne, you see what you have to do with your questions? Type them, copy, paste. Just messing with you. Right here. Bruno, if you had a bankruptcy over 7 years ago, can you obtain a mortgage and a real estate license? Absolutely. You could have had a bankruptcy a year ago, and you might be able to get a mortgage. There's lenders for everything. As far as real estate license, doesn't affect you. Mortgage license, this might affect you, depending on when it was. Okay? Sabrina, can you go back to the 15.1 calculations or figure? Let's see. Good night, guys. Good night, good night, good night. Those of you saying good night. 15.1. So this is 15.1. Where do you want me to go? Oh, sorry. Where do you want me to go? Good night, Gil. I will. Thank you. So, Sabrina. I wrote what? You're talking about this? Oh, okay. No, you said figure 15.1, and this is, gotcha. All right, cool. Good night, Myra. Thanks, Daphne. All right, you're redeemed. You're redeemed for today. Good. Do you have a question here, Sabrina, or you just want to... Okay. Um, Hold on. Let me go with Vanessa real quick. Vanessa's question. That's good, chat. You learn more. So there's going to be a lot more stuff because there's a new edition coming out. All right, let's see. So Sabrina, I'll go over in a second. Let me just see what Vanessa has here. I would like to know if the buyer wants to get two different types. Good night, Nicole. Two different types of mortgages, like one residential, one commercial, and the commercial can auto pay the loan. So you're saying the commercial, whatever comes from the property, pays the loan. Okay. Is there any problem with the bank approval? Okay. There's not many lenders right now that will allow you to have two loans at the same time, like being able to close at the same time. Is it possible to get a residential and then a commercial later, or get a commercial and then a residential later? Yes. So if you have the commercial first, let's say, okay, it puts you in more power because there's income property, so it adds towards your income when you go buy a residential property. So any income that you have, whether it's a wage or it's property income or dividends that you get, all that adds up to your purchasing power. You got it? But if you have residential, this is why I was telling you that people shouldn't buy a single family as their first investment. Because if you have residential, it's an expense only. Like a single family is expense only. So it counts against you. You got it? So that's why you should go always for multifamily first. If you can get into commercial, it's great. Like 5 units or more, or if it's a strip mall or whatever, office building, commercial, anything outside of the 1 to 4 family is great. But always try to go for an income producing property first, because it will help you with future purchases. Okay? So Sabrina, all right. So what I was saying here is addressing this. Okay? There are closing costs with every loan, right? So estimated closing costs are $8,000, but you got to bring $16,000 to closing. Why? Because it's the difference between the down payment and whatever you put in plus the closing costs. And that's what I was showing here. I showed right here, I said one is the good faith deposit, right? So where you put $1,000 towards the purchase, so that's why it goes with the offer, right? And then 3 business days later, you give a second deposit when attorney review ends. You give a second deposit of $4,000. So how much did you put up front? You put $5,000. You got it? Now you had to bring, because of the loan that you're getting and the amount you're borrowing, right? You had to bring $20,000 towards down payment. The bank will finance the rest. Okay? So $20,000 is down payment. Because you had already put the good faith deposit, right? Then how much do you need for the down payment? Now you only need $15,000 towards closing. But then there's the closing costs. Closing costs, if you go here, were $8,000. That was the estimated closing costs. What are closing costs? We just went over, it's all these fees. It's all these fees that we were going over, appraisal fees and all that stuff. These will go towards the closing costs. A total of $8,000 in closing costs. Okay? So what we're going to do, if you look right here, it's simpler here. What you're going to do is, you needed to come up with $18,000 in this scenario versus 20, right? But you had deposited in this scenario $10,000. Okay? So how much do you need towards the down payment? $8,000. But $8,000, which is the difference between these, right? $8,000 plus the $8,000 on top is a total of $16,054. Okay? So that's what I was showing you. How do you calculate how much money you need at closing? It's closing costs plus the difference between the deposit and the down payment that's required. And that's what we got here. Cash to close total, $23,000 in this particular scenario. Okay, so 1, 2, 3. Got it? You're welcome. Daphne, are we going to review how commissions are paid? What do you mean? To you? That you review with your broker, but commissions are from the top. Yes, we'll talk about it later. Commissions are from the top. So if the house sold, for instance, the house sold for $200,000, right? And the total commission was 6%, right? Then it's 6% of the sales price. So this is the sales price. Commission is 6% of sales, not the net, is the gross. All right? Got it? So this would be $12,000. This $12,000 goes to the broker. Now, if you find the buyer and the seller and the buyer, your broker gets the full $12,000. But if not, then they're gonna have to split with the listing broker and buyer's broker. So they split the fee. How much do they split? Whatever the agreement was. But let's assume for this example, it was 3% and 3%. That means that the listing broker gets $6,000 and the buying broker gets $6,000. But this is the broker, this is not you. How much do you get? Let's say you're the listing agent and your agreement with your broker is 50-50. That means you get $3,000 as a salesperson. Okay? If you're the buyer's broker, let's say as an example, and there's a 60-40, right? That means you get 60% of the sale and the broker gets 40% of the sale. You got it? So that's pretty much how it works. Good? But that's independent agreements with you and your broker. So that's why we don't go over it here, because that's totally independent. All right. Question. For down payment, is it usually on contract before the buyer goes into the contract? When you get approved, pre-approved for a mortgage, they tell you all that. So before you even get into any, this is why, guys, this is why it's so important to meet with the mortgage professional first before showing houses. Because if you don't have enough amount for the down payment, it's the same thing going to a restaurant and not knowing if you can afford the meal. What's the point of even going? All right? So make sure you have the money before you go buy. Simple. So yeah, usually up front, and this is, Ricardo went over it with the LTVs, loan to value ratios. That's what it is. The bank will lend you or pre-approve you at a maximum of a certain amount. The difference is the down payment. Yep. Okay. Any other question, guys? Questions? 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 All right. Good night, Sandra. Good night, Daphne. Jane, good night if you don't have any questions. And David, I guess, is the last one. Good night.